We're going to see tightening through the back end of the year into the middle of next year, and then quantitative tightening, QT, continues in the background.
It's unsustainable to have the Fed hiking rates at a very rapid rate, doing QT with the economy slowing.
There is some thought that we're getting to peak hawkishness, but that's not going to move the market now.
The bigger risk and tail risk aspects are going to be really European energy crisis and how midterm elections go this year.
I do think the slowdown could be more significant than many economists are expecting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Fed Decision Day Wednesday, live from New York City. For our audience worldwide, that's not going to catch on, is it?
Not at all.
Okay. Good morning, good morning.
Add some more syllables in there.
This is Bloomberg Surveillance, live on TV and radio, alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures up TK, a third of 1%. We're looking for another 75 basis point hike later on.
Market's very dynamic into this decision this afternoon. We're going to start strong with Dominic Constam here in a moment. John, the FX market says it all, but I'm sorry, I'm going to push it aside for the real yield. Everyone out there noting that finally the real yield matters.
Can I get to Japan flying solo straight off the top? The 10-year bond of Japan, Tom, hasn't traded for 2 days for the first time since 1999. Before we get carried away with the Federal Reserve, the Bank of England, the S&P tomorrow,
yeah.
The BOJ is going nowhere, it seems.
Well, they're going nowhere. 143.90 on yen, and maybe it ought to be at a 1.5 but everybody's afraid they're going to act to make yen stronger. And what it really speaks to, John, is what shifted in the last few days. And I'm sorry, this will infect the press conference this afternoon. EM gives way more than the major pairs here against dollar. That's got to get everyone's attention at the press conference.
It's got our attention already in a massive way. Lisa, the amount of work this Fed has done in such a small amount of time. Fed funds has gone from the middle of March at about 0 to 6 months later, basically at 3%, a little bit later on once they're done hiking 75 basis points. We went from the end of 2015 at 0. 3 years later, we got to 2.25% on Fed funds. Just think about how much it took last time, over 3 years to get there, and this time about 6 months to do even more.
So are we there yet? Right. I mean, I think that's the question. People are going to be looking for some kind of answer. How high are they going to go? What's their dot plot? People are going to be looking at that, even though inside I cringe and feel like this is a completely moving target and doesn't give you any real information. But nonetheless, people will be targeting it, and it will be guiding the markets post-Fed meeting. But how much can we talk about a 4.5% Fed funds rate, a 4.75% Fed funds rate, as we heard from Bob Michael on your show yesterday with JP Morgan Asset Management?
Bob was fiery.
Yes, he was.
4.5 treasuries.
Yeah.
He's talking up 750 basis point spreads, and he's basically saying, wait for the recession. Have patience. We're not there yet. Wait for it. Until then, big cash position.
What's interesting to me is he flicked at the divergence within his own team when it comes to credit, when it comes to the fact that you're finally getting yield, to Tom's real yield point, to the fact that you're getting 8% on credit. He's saying, just wait, right? To your point, John,
yeah.
It could go up to 12% because we have not baked in a recession. And this really shows how difficult this situation is for investors who really haven't seen this scenario for decades.
He talked about a generational divide within the bank, Tom. He said that the people that had lived the 1980s on the trading floor had a very different opinion about where this was heading compared to the people that joined the bank coming out of the financial crisis.
John, it's like BitDog. I strongly agree that there's a generational memory here that a lot of people don't have. It's new territory for a huge percent of our viewers and listeners.
Let's get into this market right now. Futures up by about a third of 1% on the S&P 500. On the Nasdaq 100, up a tenth of 1%. So many messages this morning about Fed day performance. Over the last 18 months, this from the Bloomberg team, the S&P 500 index has risen after 8 out of the last 10 Fed decisions. Lisa, I think a lot of people are aware of that now, and I wonder what that means for the Fed day performance today.
Yeah, I wonder if people are going to look past this one to perhaps half a month after, which tends to be quite different, considering that people usually take 2 weeks to really understand what Fed Chair Jay Powell actually says, because usually he's come out with hawkish proclamations, and people don't adjust until they realize, oh, wait, they're serious about it. So we're going to get something of the same today. At 10 a.m., here's what I'm watching. Bank CEOs, including Jamie Dimon of JP Morgan, Brian Moynihan of Bank of America, as well as others, are coming to Capitol Hill to testify before the House Financial Services Committee. A lot of this will be trying to get some sound bites for different different advertisements for different political candidates, but how much do we get a real assessment of how much inflation is biting into the average consumer? We are going to hear a lot of questions about inflation. How much do we get a sense? Yes, of course, the politicians are going to ask the banks, what can you do about this? But how much do they give a sense that really there is hurt that is spreading more rapidly than perhaps the real-time or lagging data really is capturing? Today is day 2 at the UN General Assembly. I will not call it UNGA. I really agree with you, John, and I actually was struggling with this. Tom, you missed this. We were discussing UNGA and whether that's an appropriate denomination for United. I kind of agree. President Biden is speaking at 10:35, and he's meeting with UK Prime Minister Liz Truss at 1:15 p.m. What did you call it? Icy? It's going to be frosty. Yeah, it's going to be.
Maybe.
There's some issues.
I've got no idea. I'm just suggesting it might be.
They're dealing with certain issues having to do with Northern Ireland and a couple of other issues. And of course, her plan that she's unveiling isn't necessarily ingratiating her with a lot of economists, certainly locally in the United Kingdom, as well as here. And at 2 p.m., there is an FOMC rate decision. I hear it's FOMC rate decision on Wednesday, followed by a press conference with Jay Powell. Real yield, yes, but the dollar dynamics are really telling. And John, we're seeing the dollar strengthen to the most going back to 2002. Yes, this is a Europe story with the European situation getting a little bit worse, at least in the perception of the FX market. How much does this cause real disruption? And I'm going to be focused on that.
What a chart. Lisa, thank you. Appreciate it. Joining us now, just a fantastic lineup today. And it will climax with former Vice Chair Rich Clarida a little bit later. We can kick things off with Dom Constant right now, the head of macro strategy at Mizuho Americas. Dom, at the epicenter of your work, you're expecting inflation to fall and fall so much more quickly than people expect. Dom, why is that your position?
The main thing on the inflation side is that you have profit margins that expanded through COVID and are still very, very high, which means all of the cost inflation has actually been passed through into prices, and then prices have gone up even more because of that expansion. And you can break it down in the GDP data and show that for 10% inflation, about 4% or so is cost, and about 6% is due to profits actually expanding. So that actually means a soft landing is actually still likely because companies can sort of cut back on those profits and still bring down inflation without necessarily having to fire people as rapidly as you might otherwise think. And what they end up doing is they end up tolerating very weak productivity, relatively strong employment. You can still get lower inflation, and it's a soft landing. Ironically, though, it's just a bit tougher to get inflation down. You need to work on, obviously, tightening financial conditions and raising real interest rates, and Dominic, that's kind of where we are now.
If all central banks are ex post by definition, what is their most efficient, best policy given the stochastic nature of up inflation and then sharp disinflation? What's their best practice right now?
I mean, it's tough. It's partly in the US, for example, the housing market, obviously, a lot of people have locked in interest rates. Okay, they're not going to be moving house, but, interest rate impact on slowing spending when also there wasn't very much equity extraction in the first place just makes it all very tough. I think it will take time. I think time is probably what you need. And the Fed is finally only just really moving through the neutral rate now and getting restrictive. So I think the message from the Fed is policy rates and real rates, yes, those are the things they need to get up, but they have to keep them there, which is kind of the message. So it's not really a story about zooming them up aggressively and then reversing. It's more a story about getting to a steady level of restriction and just being patient and trying to convince people that they're taking the medicine for their own good, and things will at some point normalize.
Dom, how lonely do you feel in your soft landing call right now?
Very good, actually. A soft landing doesn't mean the Fed doesn't have to raise rates and doesn't have to maintain rates, and the curve could stay very inverted for a while. What it means is that the employment losses, if you like, are somewhat capped as inflation comes down, and so you might well see unemployment rise to 4.5%, 5%, maybe even 5.5%. But in the end, inflation really ought to come down quite a lot. It doesn't mean you have to take unemployment significantly higher and unravel everything that kind of was achieved in the post-COVID period.
Well, I was just wondering how much pushback you're getting and whether you think that a hard landing, whatever that means, maybe higher unemployment, maybe negative GDP growth, whether that's baked into equities and that you should go long risk because you have a more optimistic view than the rest of the world.
Well, I think the hard landing story kind of links to very deep losses in real GDP, and obviously a very sharp increase in the unemployment rate and a kind of collapse in profits. So the soft landing still gives you a very weak GDP, maybe not as weak. I mean, you could be bumbling along zeros and small negatives. You just don't get the big increase in unemployment. You just get the very bad productivity growth on the back of it. And profit margins are the main thing. They come in, but I always look at operating earnings and say, look, if in the peak they might have been over 200, they're going to trend is like 180. They come down towards trend, but a hard landing they'd come much lower. So it's not great news for equities, but it's not a complete disaster. Is the way I'd put it. And financial conditions, are going to stay tight for a while. So it's going to be a bit frustrating. So there are nuances to the differences between hard and soft.
Dom, thank you for joining us today. Dom Constant there of Mizuho Americas. Abramowicz, I imagine that Chairman Powell's address in the news conference won't sound anything like what we just heard in the last 5 minutes.
Probably not. He's going to talk about the need to get rates higher, that they're not that close. They're going to keep going. They're perhaps halfway there, perhaps less than halfway there, depending on whether you're JP Morgan Asset Management, or perhaps more than halfway if you're taking a look at some of the pushback that they're going too hard. He's going to have to come out and be hawkish, otherwise massive undermining in credibility.
And bearish on the economy, potentially. Chairman Powell talked about the pain in that Jackson Hole speech. Tom, I went back over it last night. And in that paragraph, those couple of sentences where he talked about pain, I just wonder if it's captured by the forecast today, because in a previous round of forecasts, it wasn't really at all.
I never look at the forecast. John, I don't believe in the dot plot. This time it matters. I make an exception. The forecast, and Michael McKee will break that down. It really matters.
Hold on a second. Are you going to be looking at the dot plot, Tom?
No, I'll be looking at the forecast.
News. Okay.
I will not be looking at the dot plot.
Okay, so that doesn't matter still.
Which I consider a huge mistake. But, John, the forecast today really mattered.
I'm proud of you, Tom.
Thank you.
Just for opening the summary of economic
Can I
projections.
just tell you, you're so on UNGA, it's disgrace. And it reminds me of the Blue Swede redo of B.J. Thomas, Hooked on a Feeling, 30, 50 years ago, where they open up Ooga, Ooga,
Ooga
Chaka,
Oh, yes,
Ooga,
you know what
Ooga.
he's talking about.
I can't believe the team made that banner.
I'm not going to Ooga, Chaka, Ooga,
Can you really
Ooga.
not believe that?
No.
Sure. Are you going to sing
Deep
us out?
inside of me. Yeah,
Okay.
UNGA's a disgrace. It's the United Nations General Assembly.
Well said, Tom.
Thank you.
That's what I said yesterday too.
Chaka.
It's good to have you back.
Yeah,
Futures up 0.2 from New York. This is Bloomberg.
Tom Keene back in full force, keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Vladimir Putin declares it a fight to the death with the U.S. and its allies. He is calling up 300,000 reserve troops in a major escalation of the war in Ukraine. Putin also hinted at the use of nuclear weapons. He said that the U.S. and its allies want to destroy Russia. A Ukrainian counteroffensive in the last few weeks has dealt Russian troops their worst defeats since the early months of the conflict. The Federal Reserve is poised to raise interest rates today to the highest level since 2008, and it's likely to forecast that there will be further increases. For the third straight meeting, policymakers are expected to raise rates by 75 basis points. Fed Chair Jerome Powell is expected to stress the Fed's resolve to curb inflation that's near a 40-year high. The Bank of Japan is trying to cap upward pressure on yields before a policy decision later this week. The central bank announced an unscheduled bond buying operation. BOJ Governor Haruhiko Kuroda has emphasized his determination to maintain rock bottom interest rates, even though many other developed nations are increasing them. British Prime Minister Liz Truss reportedly will cut the rates of stamp duty for home purchases. That's according to the Times of London. The newspaper says Truss will announce the measure Friday as part of a budget to stimulate the UK economy. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Such sham votes, referendums, do not have any legitimacy, and therefore they don't change the nature of the conflict. This will only further worsen the situation, and therefore we need to provide more support to Ukraine.
That was Jens Stoltenberg, the NATO Secretary General, with Bloomberg's Anne-Marie Hordern. From New York City this morning. Good morning, Tom Keene, Lisa Abramowicz and Jonathan Ferro, counting you down to a Fed decision with equity futures just about positive, up 0.25% on the S&P, on the Nasdaq up 0.1%. Yields coming back from multi-year highs on a 10-year, down 2 basis points, 353.77. The dollar stronger, euro dollar, Tom, negative 0.5%, 99.25, as the Russian leader mobilizes even more troops.
Years ago, I was in the bottom of a hotel in Chicago with the laureate Thomas Schelling, the giant of game theory and war. And one of the 6 people we were with simply said to Dr. Schelling, "How do wars end? Nowhere like this morning does this matter." With us, Anne-Marie Hordern here on the game theory of Vladimir Putin. You have a wonderful history here based out of London of studying Russia. You went to Vladivostok, am I right on that?
And a few others.
Long ago. How do you respond as a journalist to these threats of nuclear war from Mr. Putin?
Well, I think he's just upping the ante yet once again. I mean, we've seen him do this already before, this threat of nuclear weapons, but clearly he is making this move as he sees Ukrainian forces make inroads in Ukraine. They were able to capture, I mean, we're talking about the size of Delaware, Rhode Island level of Kharkiv.
Yes.
Now he is going to have these sham referendums in Donetsk, Luhansk. This is the Donbass region he said he always wanted to have. And then Kherson and Zaporizhia, and that will connect him to Crimea. And by doing that, he is calling up reservists. Mm-hmm. And this is how he's making a play to the Russian people. And at the same time, telling the West, I am prepared to take it to that threat level that would make everyone incredibly uncomfortable.
Every single military expert I have spoken to says it's just a threat. He would never do anything short-term, medium-term, long-term nuclear issues. I'm not an expert on it. Every single guest says it's unthinkable. But we've been at that spot before, haven't we?
Right. And he's done the unthinkable, right? Not everyone also thought, including President Zelensky, that he would even make inroads into Ukraine the way he did. What I would say is, and this is on background from someone who really understands the Russian apparatus, had told me that the reason why he does not think Putin would ever go for the button on nuclear weapons is because he is not sure if his military would carry it out. And at that point, his reign would be over.
Anne-Marie, a lot of people are talking about the European response, the potential United States response, the potential for there to be, for example, jets sent over to Ukraine as a possible response to an escalation by Russia. How united have people seemed in your discussions at the UN General Assembly Council?
Well, at this moment, they're incredibly united. And what else can you say, right? Putin is having sham referendums. And then at the same point, he's telling all of the West to be on guard. Do not call my bluff. Those were his words last night. So what you have is the United States, the NATO Secretary General, all of these countries, Olaf Scholz, all of these leaders, especially on the having bilats this week alongside the UN General Assembly, having and this gives it almost a new impetus to have that fresh unity. That for all of this week going into this meeting, the big question was whether or not they are able to remain united going into the winter. This almost forces their hand to make sure they can make that case to their own economies and societies.
I'm looking right now at natural gas prices that ticked higher on the back of this news. You see Brent crude ticking higher on the back of this news. What's the case for why that is really happening, given that a lot of the bad news has already been accounted for and priced in?
Well, it's just more geopolitical risk. If there's a nuclear war, the markets obviously. This is something the markets are watching. They thought potentially at some point there could be peace negotiations, especially when you had Ukraine making up some of this territory in a very successful counteroffensive. So this is just going to add to the geopolitical risk. Also, we need to really unwrap what is going to happen this winter in Europe. And what we're hearing right now overnight, Germany has taken Uniper. They nationalized it. I spoke to the Qatar foreign minister yesterday. Scholz will be in Doha on Sunday. They are still trying to make sure they have enough natural gas to get them through this winter and obviously the following and the following winter.
It's just thinking about the president's address a little bit later this morning. Do you expect him to address some of these issues?
100%. The president is really going to make his speech about something we've heard him talk about before, democracies versus autocracies. And he's going to talk about the, quote, naked aggression, according to his national security advisor, Jake Sullivan, briefing reporters yesterday, in terms of what Russia is doing in Ukraine. And here's something else the president is set to do. He's set to talk about the principles that work for all countries and that pushes back against aggressors who seek to threaten, coerce, and intimidate their neighbors or to violently attack them. He is likely going to call out Russia, which is on the Security Council, which makes you question, can the UN really do anything?
It's a very good point. Anne-Marie Hordern here in DC. AMH, thank you. For the UN General Assembly, this tweet just came in some moments ago from Horseshoe Loves on Twitter. Agree with your detest of the UNGA acronym and the doctrine to call mature institutions by their proper name. So you're going to stop calling Tom Keene TK now?
Oh, no, you can call me TK, John.
I think we run with TK. Are you a mature institution?
I was about to say.
No, but I'm an
That's
institution.
amazing.
My mother called me TK, so I frankly love it
She
when I
did?
hear TK. My mother called me TK. My father called me Hey You. John, team coverage in London. It was very important that all of us were steeled for what went on with the drama of the funeral, the mourning of a weekend line. And, frankly, I had to drill deeper into the culture of London, and so I migrated north. Anne-Marie Hordern helping me out here on the move up. And oh my word, it was team coverage from London.
That was your view, Tom.
That was my view
That's
here.
That's very cool.
And this is, John, explain the majesty of Mr. Son coming in and scoring 3 goals in like 13 minutes.
That's how you get a player, Tom, to fight. You put him on the bench. And then you bring them off the bench and they've got something to prove. And he had something to prove. And those first 2 goals of that hat-trick, Tom, were just absolutely awesome. Can you describe the moment, Tom? Your first English Premier League football game.
I loved it. I teared up, except every bartender and cigar bar I went to, they were all Arsenal fans. I don't understand
Quite
that.
a game to go to, Tom. 6-2.
Yeah.
You're complaining about low-scoring games, and you've got a 6-2 game as your debut appearance.
Yeah, it was fascinating to see. I saw the VAR in action, which I still don't understand. I saw penalty shots stopped that was taken back and on. But what I really saw were the British people. It was stunning, John. When they sang God Save the King, it was just lights out.
Go and say it. Best sport in the world.
Best sport in the world. Thank you to Tottenham and Mr. Levy. I really appreciate that moment.
Just repeat after me.
No.
Best sport in the world.
He's on
Call
board.
it football.
No, I'm on board.
He's on board.
Thank you, go Spurs. Thank you, Spurs. Thank you, Arsenal.
Now he's calling them
Aston
Spurs.
Villa.
What the heck happened?
No, they're the Tots. They'll always be the Tots, but thank you, the Spurs.
Live from New York City this morning. Good morning. It's the price action on this Fed decision day. Futures positive by 0.25% on the S&P. You're all familiar with the statistics of the Fed day decision price action. Bloomberg breaking them down for you. In the last 10 Fed decisions, 8 of them, this market has rallied, and you've seen some big moves so far this year. Are you going to push back against that view this time around? The Nasdaq positive by just 0.1%. In the bond market, massive changes at the front end of the yield curve on twos. Right now, 395.25 came very, very close to 4% in yesterday's session. We started the year at about 76 basis points. 12 months ago, the 2-year was at 21 basis points. We even started the month at about 349. We just keep adding more and more weight to the front end of the curve. It's been the theme so far of the year. The 10-year also, I think this is the 8th consecutive week that yields have been climbing, 353.77 on a 10-year. Yields come in just a couple of basis points. It hasn't just been the United States, though. Wanted to take a global snapshot of what's happened in the global bond market and look at core government bonds exclusively. We can take a look at a 10-year Treasury up more than 200 basis points year to date. A 10-year bund. Remember, on a 10-year bund, we started the year in negative territory. We're now plus 200 basis points to about 188. And Tom, you'll notice something that sticks out like a bit of a sore thumb for the BOJ.
Oh, this
Yields
is...
have barely moved on a 10-year JGB because they've kept that thing capped, Tom, at around 25 basis points.
We got to sit on this for radio right now. This is 3.5, Germany 1.9, Japan 0.3. And, John, it really speaks to the impossibility Japan is in.
TK, can they keep sitting this out? Can they keep sitting this out as the pressure continues to build? And we've been exploring this in the last week or so. What would happen if the BOJ abandoned that yield curve control story to the rest of that bond market board?
It's got to be played out through foreign exchange, and you're seeing it. And what hasn't happened here, folks, in the last 2 or 3 days is, again, yen has not gone 144.45. Right now, dollar yen 143.90.
Stabilizing in the 140s, Tom, is probably not what they are hoping for through the rest of this year.
Very good. We will continue here right now, and with the Federal Reserve coverage today, and look for us this afternoon. We're really ready for this with Michael McKee, of course, in the press conference. Peter Hooper joins us now to say he's global head of economic research at Deutsche Bank. Barely describes his contribution to economics and how he and David Folkerts-Landau have led in research in this crisis. I'm going to state, I may be wrong on this, they discussed recession first. Dr. Hooper, thank you so much for joining us today. I want to go to the Deutsche Bank reach, and particularly the work of Michael Spencer in Tokyo in the Pacific Rim that you people have done for decades and decades. And I just wonder simply, when I look at EM currency give way on this day of the Federal Reserve, for Chairman Powell, is he going to be overcome by events?
Chairman Powell has got one mission, that's to deal with inflation. This certainly is putting pressure on other countries. A strong dollar is adding to inflation pressures just about anywhere you look at this point. But that's not going to deflect Chair Powell on his mission. We're going to hear a hawkish message today. It's probably going to drive the dollar further.
Is it a hawkish message towards neutrality, or are we at an even general equilibrium? And today, do we become restrictive?
No, 75 basis points today is not yet going to put us in restrictive territory, given where inflation is, given how tight the labor market is. My colleague Matt Lazzetti did a great piece last week indicating why we need to get to close to 5%. You have to add not just the inflation picture, but the tightness of the labor market that Powell has been talking about as being central to this inflation problem. I mean, labor market, we see the NAIRU running above 5% in the 5.5% range, given all the various indicators you look at for tightness of the labor market. We're just way beyond norm on a lot of different metrics, not least of which is where wage inflation is now.
Peter, that call from Matt last week, we all read that piece, close to 5% on Fed funds. Let's dig into that. The pushback that I got when I put out that research on behalf of you guys, and a lot of people sent messages to Lisa, to myself, to Tom, and basically said, how on earth can we live with 4.5, never mind 5? What does the economy look like with 5% Fed funds?
The economy is going into recession here. We're not expecting it till the middle of next year, perhaps a little sooner. But that's part of the way you're going to have to ease up on this labor market. In order to ease up on the labor market, you can't bring down vacancies by themselves. Historically, it's never happened. You're going to have to see the unemployment rate go up. It's going to have to get above 5% in order to deal with inflation, with the inflation problem we have here. So, financial conditions have not been helping out until we got to the reversal in the CPI for the August numbers. But we have further to go, and the Fed's going to have to push harder. It's going to have to get up into restrictive range, which we think is certainly 4% plus for right now.
Peter, it sounds like Deutsche Bank has been getting more bearish generally on the global economy, as well as how far central banks will have to go. Earlier this morning, your bank put out an estimate for European GDP, revising it downward to negative 2.2% for next year from 0.3% of a decline, basically a deeper recession in Europe. Have you had the same kind of revision to the U.S. view based on how far the Fed has to go to stymie inflation from here?
Well, so in Europe, Europe's been hit not just by the inflation problem and the tightening by the ECB, but obviously the cutoff of Nord Stream 1 has had a major impact. We've revised our growth rate for Germany down from minus 1% to minus 4% next year. Mark Wall, our chief economist for Europe, as you say, put out a very nice piece this morning indicating the spillover from Germany and the rest of Europe being somewhat affected by the gas cutoff is enough to certainly put us in recession. Now that is a modest negative for the U.S., but it's certainly not enough to put Powell off course at this point. The inflation problem is going to be there. It's going to continue, and this tight labor market continues until we see some real slowdown in the U.S.
Peter, well, I guess that I'm trying to gauge the depth of the recession that you see in the United States. You do say a 5% NARU neutral interest rate. You also are looking at unemployment for above 5%. Do you have a sense of the duration, not only of how long rates will stay there, but also of how long we will be in a negative growth, higher unemployment kind of environment?
Well, we expect growth to slow noticeably in the first half next year. I mean, part of what's happening here is we've seen this rotation of spending from goods where production was ginned up substantially. Now that's shifting over to services. Inventories are running up. We're going to have to see some inventory adjustment first half next year, which will certainly begin to slow things. Then we think that this war chest of savings that the house is supporting the households will begin to run down enough for consumer spending to begin to slow by the middle of next year. We're anticipating negative growth for the second half next year, minus 3.5% at an annual rate in the third quarter. Another negative, not quite as deep, in the fourth quarter, and then beginning to come back in 24. So it's a relatively moderate, relatively brief recession. The Fed begins to reverse course on its rates because that slowdown is going to help bring inflation down and allow it to reverse course, something that's not in its current forecast at this point.
Peter, is the recession spread evenly across America? Does a certain part of the public face the Deutsche Bank recession call and others can escape its grasp?
Well, it's always a way, if you will. I mean, there are wide range of income distribution, and certainly lower income households are going to be hit harder. Will be hit more on the job front. That's the unfortunate part of this. But I think, given the recession is going to be consumer-driven, it'll tend to be more broadly based than something that's initially a big housing crunch. But yes, this will be a broad-based recession. It's not going to hit all.
Some big calls in there, Peter. Fantastic to read the work of Deutsche Bank over the last few weeks. In fact, for most of this year. Peter Hooper there of Deutsche Bank Securities. Tom, that call on NARU being somewhere close to
stunning
5%.
Right.
I wonder where the Fed is on that and what it means for their unemployment projections that ultimately need to factor in higher unemployment to get inflation lower. If he believes it's close to 5, that's a lot of work to be done.
It's not the NARU jacket of another time and place. NAIRU, and all you need to know is the first two letters are non-accelerating. It's the quiet point is calculated with some unobservable data points, John. It's something people enjoy flunking on economic exams, but it's the quiet point you have to get to get the slowdown done. And to have it above 5% is something a huge body of people have never experienced.
I wonder where that leaves their forecast, Tom, because year-end the Fed's got unemployment at 3.7, 23 at 3.9,
yeah, they're gonna
24 at 4.1.
They don't have the luxury of young Luzetti of UCLA and Deutsche Bank. They've got to spin a message, if you will. And this is true of every single institution, folks. They've got to spin a message that's appropriate and gradual, where with Deutsche Bank, there's a suddenness to it.
And those forecasts are set to be updated, Lisa, a little bit later this afternoon.
I want to see what they are. I especially want to understand how high they expect to have to go because of the resilience in the economy. And every different analyst who I've spoken to has said that right now this economy has been able to withstand higher rates better than so many people had expected because companies had termed out debt, because individuals hadn't taken on as much debt, because people had locked in fixed rate mortgages. All of these things that make it a less easy transmission of monetary policy, forcing the Fed to go further. How are they going to recognize that and how that's going to force their hand with a lag effect that we can't really see right now?
They are the two major questions right now. How much higher rates need to be to bring down growth and how much lower growth needs to be to bring down inflation. That's going to be a key feature in the conversation around the Federal Reserve a little bit later. And a key feature of our conversation with the former Vice Chair Richard Clarida joining us straight after the Fed decision. And then he's going to stick around for the news conference, which I just think is incredibly cool. He's going to catch up with us after the news conference with Chairman Powell and break what he thinks down is going on, Tom.
Oh, it's going to be fascinating. What an honor to have him here. He's the academic from Columbia with massive monetary chop. First question for me, John, is to know, are they making it up as they go?
You will get the first question. Up 0.2% on the S&P. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin is threatening to escalate the war in Ukraine even further. Putin is calling up 300,000 reserve troops and vowed to use all means necessary to defend Russian territory. He also hinted at the use of nuclear weapons. Meanwhile, the Kremlin is moving swiftly to annex parts of Ukraine occupied by Russian forces. The Fed's ready today to hike again and to send a hawkish message. For the third meeting in a row, policymakers are expected to raise interest rates by 75 basis points. That would bring rates to the highest level since 2008. Chair Jerome Powell is likely to hammer home that he believes further rate hikes are needed to tame inflation. European Central Bank President Christine Lagarde says borrowing costs will rise more in the months ahead. Speaking in Frankfurt, Lagarde said the ECB has taken major steps to tackle inflation, and she expects to raise interest rates further over the next several meetings. The special master in the Donald Trump documents case is skeptical of some of the former president's arguments. Federal Judge Raymond Dearie pushed back on the Trump lawyers' position that they didn't need to detail any alleged declassifications of highly sensitive records. He said the Justice Department had presented evidence that several of the documents were classified. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We saw such high increases due to speculation over the geopolitical situation and some of the other issues that we're now seeing a kind of backing off of that. I mean, I think $120 a barrel was too high for the supply-demand situation, and so we're seeing that back off.
Brilliant to catch up with Ellen Wald, Senior Fellow at the Atlantic Council, live from New York. This is Bloomberg, counting it down to a Fed decision with equity futures just about positive, up 1/3%, call it that, 1/4% on the S&P, up 1/10%, on the Nasdaq 100. Yields lower by a couple of basis points, 353.77. Euro weaker, euro dollar negative 0.5% to 99.26. I can tell you the Swedish currency is getting absolutely battered again for a fifth straight session, weaker against the US dollar. Might sound left field, but just give me a second, Tom. The Riksbank out yesterday with a 100 basis point hike, and we're still getting currency weakness. Vasilios Giannakis of Citi published just moments ago, and he said a continuation of the sell-off in risk assets due to the Eurozone's strong economic headwinds and the Fed's tightening path will maintain significant pressure on both the Norwegian currency and the Swedish currency as well against the dollar. And many of these central banks, Tom, they share the same concern at the moment. It's going to be the Bank of England's turn tomorrow, hiking into a slowdown and struggling to get any traction in the FX market.
I have to look the paper up, John. It's a good 25 years old, a brilliant paper from, I believe, the Peterson Institute. And, John, it's about watching 30 and 40 currency pairs at once. That's a little hard to do, but there is a value to looking at Nakistaki or at dollar, Swede, and the rest. I mean, you've got to look at all these pairs dynamically to have a guesstimate of where we're going.
There's a similar experience at the moment, Tom, against the US dollar, that's for sure. And certainly for the Federal Reserve, it's not their problem yet. It's everybody else's. I just wonder, Tom, for how much longer that might be the case.
For those of you unfamiliar, DXY is the core and ancient index. Bloomberg Dollar Index is better math. 110.57 on DXY is a shock, and particularly a shock to the nations of commodities. Kona Hake joins us now, head of research at ED&F Man, and is just brilliant on the soft, something we don't talk enough about. Kona, the impact of a strong dollar on commodity nations, commodity EM, how large is it?
Huge, huge. I mean, if you think about only 6 months ago when the war began in Ukraine, everything went up, whether it was energy, grains, they all went up. And that was because it was highly inflationary. But then the inflationary story in the US led to a higher US dollar. That US dollar then caused that whole commodity elevation to just come collapsing down. And now we're back to pre-war levels. So yeah, the dollar impact on commodities is very intact, and inverse correlations as intact as ever.
My training is to always pivot to Indonesia and Brazil on dollar strength. Are they of interest?
Well, yes, Indonesia, obviously, palm oil, massive producer of palm oil, exporter, and coal as well. And for Brazil, I mean, particularly for the soft commodities, you cannot underestimate the impact of the Brazilian real on all of these commodities. So what we're seeing today is the strong dollar is causing the BRL to weaken. That in turn is putting pressure on things like coffee, sugars, soybeans, all the major Brazilian exports, iron ore even. But it's not just that. I mean, I think today commodities are reacting. They were positive initially because of the inflation story, but now they're coming off because the inflation story has moved to a recessionary story. And obviously that's not great for commodities, worse for metals and energy, arguably less so for softs, but it still isn't, it does have a dampening effect for sure.
The focus still very much on the energy story, especially for Europe, as they face off with a potentially catastrophic winter, depending on the meteorologist reports that we get. I'm wondering from your perspective, if the answer is what Germany is now doing, which is to nationalize energy companies, does that help support things in a more concrete way, or does it just basically put a Band-Aid over the actual bill that some of these countries are facing?
Yeah, so I think, in my opinion, it's a Band-Aid, because the reality is that none of this is providing additional supply. So we have a supply-demand mismatch right now in the energy crisis. So we either tackle demand, so you have to ration demand, and I can't see Germany effectively rationing the demand. And certainly in the UK, they're actually, in effect, subsidizing demand. So that doesn't even tackle that side of things. And on the supply side, I don't see them investing or allowing more natural gas to come out. So I don't see this as fundamentally altering the situation too much. And I think this can go on for a while.
Well, when you say this can go on for a while, there is a question of how much has already been priced in terms of what is to come for this winter. And then there is a question, as John's highlighted many times, of the duration of how long, how many years we face off with this lack of supply in the face of demand. What's your view on both of those?
So with time, humans are very innovative and markets are adaptive. So with time, what's going to happen is, as long as prices continue to provide this pain pressure, you will start seeing adaptation. So you will move towards alternatives, renewables, you will become more efficient. So that's definitely something that will happen with time. Overnight, you're not going to get that. So I think effectively what we're saying is we need that pain pressure to continue for a little bit more to materialize these kind of actions. Only then will we start seeing a proper diversification, both in terms of demand and also supply. So we can start relying less on natural gas, relying less on Russia, even relying less on LNG. I mean, I have understanding that the LNG carriers are, the freights are going through the roof. They're struggling to get hold of ships. So it's a multitude of problems that are not going to be fixed overnight.
And this is going to take a while. Kona Hag there of ED and FMAND. Thank you, Kona, as always. Several winters maybe, Lisa, perhaps even longer. And for many officials in Europe, I think that's the reality they've got to confront.
The problem is that each nation has its own energy situation, its own energy crisis. It's completely different. So how do they come up with a cohesive plan, especially when you have such differing political interests heading into this winter? It's really complicated, and you're seeing that expressed in the euro.
Bit of home bias for me, I know, but I find the UK situation fascinating, Tom, to see what this new Prime Minister's going to do in the UK, and this new Chancellor as well.
Yeah.
They're planning some very interesting things. A lot of people are worried about housing prices at the moment, and they're now looking at cutting a transaction tax when you buy a house, Tom. So let's see what happens there.
They seem little, and they're sort of sprinkling them out, of course, off the shock of the death of the Queen and a new king and a new government as well. But, John, a pregnant question here. Does she have the support of her party?
Does she have the support of the country, Tom? I think that's the big question. I think she's got the support of her party right now and the party membership.
Okay.
If that went to a general election, would she get the mandate to do the kind of things that this party's going to do, Tom? in the coming months.
Let's frame it as we did with Peter Hooper. EM decline. This is not year to date, but very close. I took it from the peak here in January or February. ADXY down a good amount. JP Morgan Emerging Market Index down as well. They're down 8 or 9%. And then, John, there's the emerging market of the United Kingdom down, I believe, 17%.
Having a very difficult time year to date.
Wow.
That's for sure. Futures positive. Let's call it 0.25% on the S&P. On the Nasdaq, up 0.1%. A Federal Reserve decision just around the corner, and they're set to hike interest rates again by 75 basis points. From New York, this is Bloomberg.
We're going to see tightening through the back end of the year into the middle of next year, and then quantitative tightening, QT, continues in the background.
It's unsustainable to have the Fed hiking rates at a very rapid rate, doing QT with the economy slowing.
There is some thought that we're getting to peak hawkishness, but that's not going to move the market now.
The bigger risk and tail risk aspects are going to be really European energy crisis and how midterm elections go this year.
I do think the slowdown could be more significant than many economists are expecting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
One more big rate hike just around the corner, perhaps even more than that. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures positive, 0.25% on the S&P. TK, the consensus view, another 75 coming right up.
And there it is. And then what will happen after that? And as Peter Hooper of Deutsche Bank told us, this is just to neutrality. This is not a restrictive Wednesday. You may get that in the last two meetings of the year. But I think, John, all agree that even with this move today, we're nowhere near finished.
And then we get the forecast, Tom. Will they forecast the risk of a hard landing in the U.S. economy?
No, they will forecast in a measured, gradual way. They are a public institution, and their number one, they'll never say it, but their number one goal is to control the message and not instill fear. They're not going to go to the fear that we see from so many houses.
Elisa, the chairman, talked about that pain in his Jackson Hole speech. He talked about pain that might have to develop to get inflation back down. Will they capture some of that pain in that summary of economic projections?
That's going to be something people are looking for the credibility of the Federal Reserve, not just for the United States. I'm curious if they reflect the pain being felt around the world, how they're gauging the international influence on the United States. When they start to care about the dollar, they're probably not going to talk about that. But that has to be a niggling point on the outskirts of Jay Powell's mind, considering some of the pushback that they've gotten from the likes of the World Bank and the IMF.
The Bank of England tomorrow, Swiss National Bank tomorrow, BOJ convening as well at the moment. Lisa, tough spots for them, those three, and maybe more so for the BOJ.
How about this for signaling? They actually engaged in an unannounced bond purchasing program overnight to support the yield peg where it is. You haven't had trading in Japanese bonds for 2 days. The first time that's happened going back to 1999. It is not a market. They are doubling down. And it's sort of surprising to me. The yen hasn't given away to new weakness. But Tom's right. We were talking about this earlier. He said people are scared to go against the Bank of Japan, to go against Japanese resolve to keep things where they are and potentially upend everything if they change that. But right now, wow, what an outlier and what a ticking time bomb.
That really is stat of the day, Tom. 2 days that the Japanese 10-year government bond has not traded for 2 days.
To translate this for non-sophisticates, they are doing a theory. It's no different than what China's doing with COVID. They've got a theory, but there's no published background. Richard Clarida, John, in all of his studies at Illinois and onto his excellence at Columbia, never has read a paper that shows that theory can work.
On market central planning. Let's see how it works out. Futures positive 0.25% on the S&P. Good morning to you all. Counting it down to a Fed decision with futures on the Nasdaq up by almost 0.1%. Yields lower by a couple of basis points to 353.97. That has not been the trend. It's been yields higher, yields higher, yields higher on a 2-year. Lisa, we came very close to 4%.
People really expecting a lot from this meeting, but also beyond. And that is a reason why the dot plot might matter to some people, why it could move markets significantly at a time when people want to understand, is this Federal Reserve moving close to the Deutsche Bank projection? potentially close to 5% neutral rates or end rates for the Federal Reserve. All right, at 10 a.m., bank CEOs, including Jamie Dimon of J.P. Morgan and Brian Moynihan of Bank of America, are heading to the Hill. They're going to be testifying before the House Financial Services Committee. A lot of theater. Curious to hear what they say about inflation, how it's affecting consumers, consumer lending. Are they getting more restrictive in how often they are lending, considering the fact that potentially people are going to have a harder time paying it back in the face of higher prices for basic day-to-day costs? Today is day 2 at the UN General Assembly. Traffic is completely clogged up in New York City. President Biden will be speaking at 10:30 a.m. And then he's going to be meeting with UK Prime Minister Liz Truss at 1:15 p.m. Curious to hear how that meeting goes, not just because of some of the tensions with respect to Northern Ireland, as well as U.S. British trade policies, but also, does he push back about some of her fiscal policies? Does he address what she's doing? Is there some sort of coherence with the U.S. support of the United Kingdom heading into also a potentially difficult winter? And at 2 p.m., this is the main event, the FOMC rate decision, followed by a press conference by Fed Chair Jay Powell. A lot of questions. You were talking about, John, whether he's going to acknowledge some of the weakness that may be required, according to some people, if we get inflation down or for getting inflation down. I'm watching the dollar. We're looking at a dollar that is the strongest going back to 2002. Yes, this is a Euro story. Yes, this is a British story, but this is also very much a Federal Reserve story. When do they start to care about this as not a positive in reducing imported inflation, but a negative, John, because what it does to the rest of the world will eventually rebound in some form on U.S. corporations as well as just generally the U.S. economy?
I've been enjoying the daily traffic report. Will you continue that?
Do you want that?
Sure.
I mean, if we really keep going with this,
daily traffic on New York City.
You have, definitely barriers on all the roads.
Yes, there are barriers.
Dumpster trucks, Tom.
John, I got out. The Bentley let me out 8 blocks away from our office here in Midtown. And the police stopped me, and of course I had a tantrum. I said, "Do you know who I am?"
I said no.
I did the whole thing. They put me in the police car, drove me out to the George Washington Bridge, and said, "Walk."
See you later.
See ya.
Do you know who I am?
Do you know who I am? That's such a TK thing
I'd never
to say.
been up by the George Washington Bridge. It's beautiful.
On the way to New Jersey, Tom?
Yeah, except I had to walk back to our office here. I think I got my
Did you
exercise.
have a look at Englewood Cliffs?
I did. I waved.
What's it like over there?
Okay, guys.
I've never been up there.
They talk about the Dow a lot on that
Okay,
side of the bridge.
all right. Oh, my goodness.
No, they do. I've heard they do.
I know.
I've heard they talk about the Dow a lot on that side of the bridge. I've got no idea why. Futures are up on the S&P by 2/10.
Dow futures up 70.
Laurie Heinel joins us now, Global CIO for State Street Global Advisors. Laurie, 75 expected today. That's what you're looking for. Can you guide us to November? Do you expect to get that guidance today?
Well, it's going to be hard to define what November brings because the Fed continues to be really focused on the emerging data. So I think that they're going to keep their cards close to their vest. We think that 75 today is almost a certainty. And we actually do think that 50 is more likely through the balance of the year. But the problem is that as long as they keep seeing this intractable inflation pressure through the data, they will be compelled to act more decisively.
Laurie, where do I hide? I mean, State Street is such a fabulous institution on sector analysis, factor analysis, diversifying into subsets, and what not to do. Where do I hide if I'm worried about what not to do right here?
Well, the best place is cash. And for the first time in many, many years, cash is actually giving you a bit of a return. So in our globally diversified portfolios, we've actually taken that cash position to about 10%.
Wow.
But interestingly, we're not just taking it out of the equities, we're actually taking out of bonds as well. So we're a bit more balanced in where we're underweight.
Laurie, can we develop that a little bit more? Which bonds? Are you talking about duration, 10-year, 30-year Treasury yields, because you see those yields even going higher from here? Or are you talking corporate credit in the face of some sort of downturn?
Yeah, actually much more focused on corporate credit and being a bit underweight there. We're sort of neutral duration, curiously enough, but it's a bit more barbelled. So cash plus long duration, because we actually are concerned that we will have a much more aggressive Fed and that will create a much more contractionary or even recessionary environment. That, again, is not our core call, but we're positions that we have a little bit of optionality if we're a little bit off on that.
Laurie, away from your remit, but let me go there to the income statement. Are there dynamics that can trouble us down the income statement at earnings or free cash flow, or is this really about a diminished revenue story?
Well, at this point in time, we don't feel like corporations are necessarily under pressure. They've got relatively large caches of cash. They actually are navigating the inflationary environment pretty well in terms of being able to pass on some increases to consumers, being able to reconfigure their operating models and things of that nature. So and oh, by the way, in the high yield indices, especially, we could actually be on the verge of some upgrades because we had a lot of downgrades as we headed into COVID. So they're actually, the fundamentals there are not particularly prickly. The problem is until we know what terminal rates are on the Fed posture, it's hard to know how to discount those future cash flows.
Is the equity market until then just totally unviable? The reason I ask this, Laurie, is it just seems to me every time we rally, get a host of people that say this is not the Fed, not what the Fed wants. They want financial conditions to remain tight and we're capped here. The Fed put is now a Fed call. Laurie, when does that change?
Well, curiously enough, and I was a little surprised to see this as well, we've actually seen net inflows into equities. So you still have had people dipping in, buying the dips. Perhaps some of it's rebalancing because, of course, equities and bonds have been down, but equities have been down more. But it's also a little bit of this fear of missing out again, because what we all know is that at some point, markets become leading indicators of future economic growth. And so if we do have a recession or a contraction, at some point we get past that. So it's still a very unsettled market, and the range of outcomes is quite large.
Laurie Harnow there of State Street. Laurie, one of the best. Thanks for being with us. Thank you very much. Lisa, that's the problem a lot of people have with this market. I remember David Costin at Goldman Sachs coming into the summer, who basically just said, we'll be capped here through the summer. The Fed's told you the playbook. They want tight financial conditions. That means an equity market that can't rally too much.
I hear that Neil Kashkari has been watching that very closely. And
well, Neil basically said that quite a bit out loud, didn't he, on that podcast,
he did.
Odd Lots, with Joe Weisenthal and Tracy.
He basically said, look, we actually would be happy to see stocks sell off a little bit more. Will we get the same kind of message from Jay Powell today? Does he comment on financial conditions accurately reflecting or perhaps not reflecting as much what they're hoping to achieve?
Can I just suggest as a fossil that if you get rates back to where they are, and as Nassim Taleb said brilliantly in the last number of days, it's, what we've been living is physics without gravity. And we're finally back to gravity, some form of risk-free rate. John, can I suggest life goes on? Like, rates go up and people adapt and adjust.
I'm with you. We talked about adapting and adjusting yesterday.
Did you?
Just because you weren't here, so we thought we'd bring it up.
Well, there were so many world leaders lined up at Gatwick, I couldn't get out with a Gulfstream.
Adapting and adjusting.
Yeah, I couldn't get out.
Gatwick. I'm not a big fan of Gatwick, Tom.
I'm not either. The drive was appalling.
Not a big Gatwick fan.
I mean, I had 3 cars with me, but
never have been. You took a motorcade to Gatwick.
Yeah, well, the surveillance motorcade.
Sun goes up, sun goes down. Companies
adapt. Mike Wilson's going to talk about that.
We adjust.
Oh, yeah, I'm sure.
He's going to adapt and adjust his schedule and maybe delay the interview. He's going to join us in 50 minutes, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin declares it a fight to the death with the U.S. and its allies. He is calling up 300,000 reserve troops in a major escalation of the war in Ukraine. Putin also hinted at the use of nuclear weapons. He said that the U.S. and its allies want to destroy Russia. A Ukrainian counteroffensive in the last few weeks has dealt Russian troops their worst defeats since the early months of the conflict. The Federal Reserve is poised to raise interest rates today to the highest level since 2008, and it's likely to forecast that there will be another increase. Now, for the third straight meeting, policymakers are expected to raise rates by 75 basis points. Fed Chair Jerome Powell is expected to stress the Fed's resolve to curb inflation that's near a 40-year high. The Bank of Japan is trying to cap upward pressure on yields before a policy decision later this week. The central bank announced an unscheduled bond buying operation. BOJ Governor Haruhiko Kuroda has emphasized his determination to maintain rock-bottom interest rates, even though many other developed nations are increasing them. It's the latest foreign takeover of a British tech company. France's Schneider Electric has agreed to buy out minority shareholders in industrial software company Aviva Group. It's a deal that values Aviva at $10.8 billion. Schneider already owns 59% of Aviva. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
our policy regarding China and Taiwan has not changed. We adhere to the one China policy. Having said that, we are concerned about China's stated ambitions, coercive behavior, and there is no reason to threaten Taiwan in the way China does.
Fantastic conversation with Jens Stoltenberg, the NATO Secretary General, and Bloomberg's Anne-Marie Jourdain. Live from New York City on this Fed Decision Day with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures are positive 0.2% on the S&P. On the Nasdaq, basically unchanged now. Yields come down about 2 basis points, 354.36. Dollar stronger, much stronger in G10. Euro dollar negative 5 or 0.6%. Just about holding on to 99 now, Tom. Euro dollar 99.16. That euro weakness this morning off the back of some strong words from the Russian leader.
Yeah, euro weakness really critical. Lisa picked this up. I missed it, to be blunt. 0.9916. Anything under a 0.99 is a huge deal, and we are there. We'll continue to monitor that. Again, the VIX 27 showing 24 to 27 in the last number of days. Tension. We will continue now on Russia and on their leader. Anne-Marie Jourdain joins us here as we just simply rip up the script. And I do so, Anne-Marie, in February announcing my book of the year, which was Angela Stent, Putin's World. With all that's going on here, how would you judge how what I'm going to call the hard right of Russia or the center of Russia or what I'd call the liberal left of Russia, how do they adapt to the comments of the last 24 hours?
I mean, they get in line. What happens when you don't? Yes, Russia does have domestic politics. You see that whether it's the Communist Party in the Duma, which John and Lisa and I spoke about yesterday. They're the ones that came up in February and said we should recognize as separate entities Luhansk and Donetsk. And then Putin went in and announced his special military operation. It was also the head of the Communist Party that said we should now be calling this a war after that counteroffensive that may have led Putin to want to actually make these moves, because now he could put reservists on the ground in these territories if he sells to the Russian people that these are legal Russian territories.
Who are the reservists? I mean, maybe it's an unfair question to you, but in your reporting...
Well, they also have contractors.
I know what a reservist is in Tulsa, Oklahoma. What's a reservist in the Ural Mountains?
It's individuals that join the Russian military that are not being used right now. You have to remember that Russia is also using a lot of contractors in this war. They're not going for full-fledged conscription, but they are calling up 300,000 reservists.
And you count them as reservists?
This is putting the backs up of everyday Russian individuals. Domestically, this is going to be a bit more challenging for Putin.
Anne-Marie, is there any coincidence or any overlap with the fact that Xi Jinping just met with Vladimir Putin and now this move of possibly calling up some reservists?
It's the first email I woke up to this morning from a viewer who said, Putin making this move after he just met with Xi Jinping. And remember, it was earlier this year that these two leaders said that their friendship has, quote unquote, no limits. What do we have also this morning? You have a seminar, a military seminar. Xi Jinping is telling that seminar to focus on preparing for war. You also have Kyoto newspaper saying that at the Party Congress next month, this is incredibly critical for Xi Jinping, that he's going to talk about his plan for reunification with Taiwan. Now, potentially, these two items were discussed amongst each other because Putin doesn't have a lot of friends right now. He has Beijing, he's getting some ammunition from North Korea, and the Iranians. That's really it when it comes to pure potential friends at this moment.
What's the U.S. doing in response to Xi Jinping? I mean, this is coming at a pretty fraught moment on multiple levels.
Well, Jake Sullivan, the president's national security advisor, yesterday said that the U.S.'s one China policy has not changed, but we heard for the fourth time from the president yet again to go a little bit more off script when it comes to Taiwan. And that 60 Minutes interview, really astonishing what he said. Not so much that they would just send warplanes and military. He was asked, unlike Ukraine, would you send U.S. personnel military, men and women? And he answered yes. It couldn't have been more direct.
Anne-Marie, thank you. AMH here in New York City for the UN General Assembly. Tom Reuters reporting early this morning. I heard you squeezing Unger. Reuters reporting early this morning. You thought that was going to slide? Come on, AMH. Tom,
how'd it go there?
I've got to squeeze this in before we get completely derailed. Just a report from Reuters this morning that one-way flights, Tom, are standing out after this announcement. One-way flights from Russia. So direct flights from Moscow to Istanbul in Turkey, to Armenia as well. Destinations where Russians can enter without a visa.
Well,
they're selling out, Tom, off the back of this.
It's very fluid in our news flow, and that's why I'm looking at more and more of the European journalist coverage that we're seeing from Bloomberg and from other sources as well, John. I'll be honest, John, I just think it's simply off the American radar, slammed in this morning, obviously, but it bears the most careful scrutiny.
Absolutely. Is that an escalation? Lisa, I think parts of the market treating it as such, an escalation. The euro weaker off the back of some of this. We saw the haven flow in the early part of the European session.
Is Vladimir Putin doubling down, right? It's raising questions about what else he could do. It does also, though, raise this issue, and Anne-Marie has touched on this very well, which is popular support of this, right? It's different when you have to actually go to war versus sit there and sort of hear the propaganda in terms of what the war is accomplishing. I wonder how much the popularity or some of the issues therein are affecting some of the jawboning, both when it comes to Russia as well as China, just based on the fact that they're heading into a People's Congress meeting that is coming at a pretty fraught time also politically and from a social perspective due to the lockdowns.
Readjusting our growth expectations lower. I saw your note from Deutsche Bank early this morning. Now we're getting real about what a recession in the Eurozone, Lisa, is going to look like.
Yeah, it was pretty depressing. I got to be honest, and the bar is pretty high for me to get depressed, but it really was depressing to see them downgrade their forecast for growth from negative 0.3% to negative 2.2%, and saying that there is potential for further downside because of the potential for a really cold winter. How much does this really get affected one way or another if there is an escalation? Does that really affect the gas supplies, because a lot of people are just discounting them altogether at this point?
Can we just compare and contrast that with the ECB's own forecasts for 2023?
What's the growth?
They're at positive 0.9% for 2023. And Tom, you've got Deutsche Bank saying it's going to be negative 2.2.
Well, yeah.
And President Lagarde was asked a lot about this in the news conference. Where's the recession in the forecast? She said it wasn't in the base case. Should it be in the base case? Because I tell you, on most people, for most people right now, it is the base case for Europe.
We're moving in real time, and as we talk about these strange things like neutrality and that, John, the lift up in German yields is a different quality of lift up than America because of their more tepid nominal GDP and their lack of technology as an economy base.
Leaving behind the negative interest rate era and moving on, Tom, with much, much high yields in Europe and beyond. Futures positive 0.2 on the S&P. On the Nasdaq 100, basically unchanged on this Fed decision day. Yields lower by 2 basis points. Your 10-year 353.97. Is this a buy for Mike Collins and a team at PGIM? We'll ask him next. Live from New York City this morning. Good morning. On this Fed decision day, here is your equity market, just about positive by a little more than 0.1% on the S&P. On the Nasdaq, negative 0.03%. You know the numbers. I'll talk about them again. Of the last 10 Fed decisions, on 8 of them, this market has rallied. Can this market rally if Chairman Powell brings out the Jackson Hole speech once more and just reads it verbatim? Once again, we've got work to do. This bond market's done a ton of work already. 12 months ago, we were at 21 basis points on a 2-year. Right now, 3.96%. Yields come in by about 0.5 basis point. On a 10-year, down 2 basis points to 354.36. A big change, though, over the last 2 months. Yields higher, yields so much higher in the US and elsewhere. Let's pick out a place where yields are not so much higher this year. Let's look at Japan. Look at what's happened with the bond market and look at what's happened with the currency, or rather I should rephrase that. Look at what hasn't happened with the bond market and look at what has happened with the currency. Yields have barely climbed this year relative to what we've seen elsewhere. They've kept them pinned lower, capped, trying to sit on them. A 10-year in Japan at about 25, 26 basis points. And look at what's happened with the currency because of that, Tom. We've had a 25% move on dollar yen. That is a monster move.
Yeah, stay on that for Bloomberg Radio, folks. 144.17 is a huge deal on yen. It's finally giving way to weaker yen just in the last 10 minutes ago. So, John, and you look where the level is, 145, 146, the dialogue changes.
Tom, even the central banks that have moved, they're still struggling. Look at sterling at 113. Yeah. Look at the Swedish currency, even with the Riksbank delivering a 100 basis point hike. Against the dollar right now, Tom, it's a tough go to get some kind of traction in the FX market, even if you are hiking, even if you're doing what the Bank of Japan is not doing.
Sterling intraday low, John, 113.05. A 112 is essentially unimaginable, except we're there right now. John, can I mention in our travels of the last 3 days for all of us, we have finally broken through on the index that matters, the Bloomberg Total Return United States Aggregate Index, summing in all the bonds. Lisa knows this better than me. Guess what? New low price on the index through the June low.
A difficult moment. I think Lisa and I are both looking forward to the conversation with Mike Collins and PGIM to see if this difficult moment is a big buying opportunity. That's the cross-asset price action. I want to get to a single name with you. We can do that now with Lisa. Hey, Lisa.
Hey, John. So, Tom's been talking a lot about companies adapting and adjusting and how they really deal with the situation that they're dealt with. And there are 3 stories today that really highlight to me how they are doing this, and that is cutting jobs and cutting jobs on a corporate level. Take a look at Gap. Their shares dramatically underperforming the broader market, down 48% so far year to date. Just announced that it's cutting 500 corporate jobs in San Francisco, New York, in Asia. This comes after their partnership with the former Kanye West fell apart. It comes as they downgraded some of their forecasts in August. How much does this really tell a story for retail? How much is this idiosyncratic? Then take a look at Boeing. This is the manufacturer of big planes. They just said that they're going to outsource some of their finance and accounting jobs to India. Their shares are lower by almost by more than 27% so far year to date. It shows how people are trying to reduce costs in different creative ways, perhaps cutting jobs, perhaps outsourcing, not exactly the jobs that they used to outsource. They still are hiring some engineers locally. It just sort of shows the shifting winds. And then Compass, the housing market company that really depends on online sales, has been absolutely decimated this year. Those shares down more than 70% so far year to date. The CEO coming out and saying that it was going to be cutting more jobs, particularly in the technology sphere, and that there's more to come. There's some losses associated with this. Again, Tom, you've been talking about adapting and adjusting. That's going to lead to the pain that we're hearing from Fed Chair Jay Powell.
Well, where's the 30-year mortgage here in like a week or two if 6.2% goes out? Lisa, to the Gap, and I think this is really important, is one of the ideas here that's new with a risk-free rate is we finally de-zombify zombie companies. Do they finally go out of existence after a 12, 13-year gift?
Which it's full circle back to your point about corporate credit. Have we fully accounted for some of that pain in that market, considering the fact that there has been the repricing that you pointed to, but potentially there could be more to come?
Very good. We will continue right now on this on corporate credit with Michael Collins, Senior Portfolio Manager at PGIM Fixed Income. Michael, what I notice here, and I understand the mathiness of it, let's forget that. Yield up, we all know that. Chairman Powell will deal with it today. But in many cases, price very, very, very down. And we're seeing it in the Bloomberg Total Return Aggregate Index, the old Lehman Barclays indices as well. What is the significance of new low price on those aggregate indices?
Yeah, Tom, as you point out, has really been nowhere to hide this year in fixed income. I mean, in our shop, we've gotten 3 big things right. We've kind of stepped aside on duration, meaning taking our long positions down to neutral. We've taken credit risk way down. We've generally been a little long the dollar, but that has not been enough to protect investors from that big trend down in prices. The good news is, as you know, when bond prices are down below par, which they all are, really for the first time I can think of in my career, Tom, we're seeing the bonds across the board, across all of our portfolios, trading at big discounts to par. And as you know, as long as they don't default, as Lisa pointed out, they end up back at par, right? So you actually have this really a positive long-term opportunity in fixed income, which we haven't had for well over a decade.
Michael, I look at the mantra of the real yield, the whole professional study of the inflation-adjusted yield. Explain to mere mortals why the real yield matters.
Yeah, I mean, that is the world's discount rate, right? I mean, I'm always surprised when people say, wow, I can't believe stocks and bonds are both selling off at the same time this year. And what I tell them is, well, you just wait until you see real estate and private debt and other assets that haven't sold off because they're not actively traded, they're not marked to market every day. Wait for those shoes to drop, because when the discount rate, the world's discount rate, which is really real treasury yields by and large, goes up as much as it has, as much as, a couple hundred basis points, all asset prices have to come down. And the question really is, have they come down enough at this point?
Well, let's get into that right now. Mike, we caught up with our good friend Bob Michael of JP Morgan Asset Management yesterday. I asked him about high yield. He said not yet. Patience. Spreads need to get somewhere close to 750 basis points. The treasuries need to get somewhere close to 4.5. The Fed funds could push 5%. Any of that resonating with you right now, Mike, or would you take the other side of that trade?
Yeah, I'll take a little bit of the other side on the rate thing. I think we're much closer on the rate side, right? Our view is that the rates are going to crest and come down first, and then credit spreads and equities will continue to widen and sell off before they settle down. But I think we're really getting close to a point, Jonathan, where the likelihood of the Fed and most other central banks overshooting significantly on the upside and having to reverse course. I know the whole concept of the pivot, was in vogue a couple of months ago, and now people are pushing that aside. And wow, as they keep pushing these rates up, at the same time that global growth, risk is coming down, earnings are coming down. As Lisa points out, defaults are probably going to go up. Geopolitical risk continues to elevate. Wow, and inflation globally is really kind of rolling over, and I think it's going to be probably a lot lower in a year from now. Just as all those things are happening, these central banks are jacking up rates ad nauseum, and I think that's a real recipe for a big reverse course on the rate side. On the credit side, I think you're right. I mean, earnings, we've done a lot of work on earnings expectations going forward, and I think they're going to keep coming down, right? And people don't talk enough about the dollar and the impact on that for U.S. companies, for their competitiveness, for their repatriated earnings. The labor costs continue to put pressure on margins. And as Lisa pointed out, you're starting to see layoffs finally happen. So I think there's a little more downside in credit before you jump in with both feet.
This is all really messy, Michael. I wonder, just to put it all together quickly, if you could give us a sense of how you play this, the conviction behind buying certain discounted bonds, taking the other side of Bob Michael, but also acknowledging what you see coming.
Yeah, I mean, you stick with higher quality credit, right? And presumably that's what a big active shop. We have 140 analysts, Lisa, right? And that's really our bread and butter. And this is an opportunity in the market where everything is kind of sold off, right, in unison to some extent. And there are a lot of relative value opportunities. You can buy really high quality credits at really big yields, really big spreads, low dollar prices. So there is a lot of opportunity there without taking a lot of credit risk. And we've taken our credit risk down, but the yields that we're seeing across the board in the bonds we own, the high quality bonds we own, the portfolios we manage, are really big, right? So, I mean, you don't have to take a lot of credit risk. Ultimately, you'll want to do that, dip down in credit, but it's definitely too early.
Just so I can quote you for the rest of the day and get it right, have you been buying this 10-year at 350, Mike?
Yeah, we haven't yet. We're dead neutral here, Jonathan. But again, that is going to be the first trade really out of the gates here, and maybe you have to wait for today. The Fed is going to probably sound pretty hawkish today, even though they've done a good job on Fed days. I know we've talked about this on the program before. Typically, the days the Fed meets and the days Jerome Powell speaks, the equity markets tend to go up. So they do a good job of getting investors off the ledge a little bit. But that dot plot is going to be ugly. I think a lot of it's probably priced in and the markets are braced for it. But there will be an opportunity, I would bet, in the next couple of quarters to really start getting long duration.
We'll catch up and talk about it. Mike Collins there of PGIM. Thank you, Mike. Now's not the time, Tom, but he did give you a sequence of events, a sequence of what he would buy and when and why he'd buy them before others.
I have trouble with the sequence. I thought it was really intelligent from Mike Collins, but what was the sequence of events 12 months ago? And
things
look where
change.
we are.
Buy treasuries first because growth's going to get hammered. This Fed will have to back away, but the pain in credit
portfolio.
will
Doug
continue.
Cass out with a note today.
What, 60-40, Tom, this year? Oof. Not nice. Futures.
I mean, it's a triple leverage cash.
Up 1/4%. In fact, TK, you've outperformed everyone this year. Congrats.
The Chancellor called me while I was...
I bet. Can you run a portfolio at the Treasury?
Yeah.
Is that what he said?
Triple leveraged all cash.
Sterling or US?
No, well, that's a really important point. You'd hedge it out.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin is threatening to escalate the war in Ukraine even further. Putin is calling up 300,000 reserve troops and vowed to use all means necessary to defend Russian territory. He also hinted at the use of nuclear weapons. Meanwhile, the Kremlin is moving swiftly to annex parts of Ukraine occupied by Russian forces. The Fed's ready today to hike again and to send a hawkish message. For the third policy meeting in a row, policymakers are expected to raise interest rates by 75 basis points. That would bring rates to the highest level since 2008. Chair Jerome Powell is likely to hammer home that he believes further rate hikes are needed to tame inflation. European Central Bank President Christine Lagarde says borrowing costs will rise more in the months ahead. Speaking in Frankfurt, Lagarde has said the ECB has taken major steps to tackle inflation, and she expects to raise interest rates further over the next several meetings. China says it has the patience to someday bring Taiwan under its control. Now, a government official said that what he calls Taiwan compatriots realize the future is in unification. That contrasts with polling in Taiwan showing skeptical views for Beijing. Beyond Meat has suspended Chief Operating Officer Doug Ramsey. He was arrested on charges that he bit a man's nose during a fight after a college football game in Arkansas. It's another blow for the plant-based protein company, which cut its revenue forecast last month. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I thought that the Fed would never get to 4%, but I've changed that view. They certainly will, and probably by the end of this year. I think they're going to have to go higher at the beginning of next year, but then I think they'll pause. I also think they'll slow down their rate hikes the further they get away from the neutral rate.
That was Megan Green, the global chief economist of the Kroll Institute, and many people share that view. That's the change for the consensus view in the last 3 months or so. Most people now looking for that 4 handle and this market price for something close to 4.5. The Fed decides in several hours' time. Live from New York, this is Bloomberg Surveillance. Equities up by 1/3% on the S&P. On the Nasdaq 100, up by a little more than 1/10%. Yields lower by 3 basis points on a 10-year, 350, 358. We've got a Fed decision, a statement, of course, a news conference with Chairman Powell. And Tom, the forecast and a dot plot in the mix as well.
We do. It's going to be absolutely fascinating. Of course, we're thrilled that the former Vice Chairman Richard Clarida will join us here in a number of hours. As well, Vincent Reinhart. He's chief economist at Dreyfus and Mellon. But on this historic day for our central bank, Mr. Clarida, Dr. Clarida would suggest that Mr. Reinhart is a must listen. Vincent Reinhart invented modern research in Washington at the Fed for Alan Greenspan and has a terrific perspective on forecasts. Maybe not dot plots. We won't blame him for that. Vince, thank you so much for joining today. I went back and I did a Google search of the Fed blinks, and there's any number of dates where this is part of the zeitgeist. When does a central bank blink? When do they stop a theory to go the other way?
When the policy choice gets harder. Right now, here's the bad news. This is the easy part of central banking because they are so far away from their inflation goal. Jay Powell wakes up in the morning and says inflation is too high. He worries as he goes to bed at night, gee, inflation is still too high. Policy choices raise rates. It'll get harder when you have to top out where you raise rates and inflation is closer to goal and the unemployment rate is rising. Then the dual mandate matters.
I said of a certain vintage, Vince, that we're sort of used to higher interest rates, like an actual risk-free rate. We've all been there before. Does the media and the zeitgeist of Wall Street, do they overplay the world's coming to an end given a march to neutrality?
Just about every time, don't they? The fact is that there are long cycles in rates. We've been here before. The Fed goes through tightening spells and easing spells and pauses. And we're just in the tightening spell. It is going to have to last longer. That's a consequence of being slow out of the starting gate. It'll have to go higher. That's a consequence of being slow out of the starting gate. But this time next year, we'll be talking about how long will the Fed be pausing.
Vincent, we were just speaking with Peter Hooper of Deutsche Bank, who sees NAIRU, or the neutral, the end rate for Fed funds rates to be at near 5%, possibly exceeding that. We're hearing more people call for a greater likelihood of that kind of pain, that kind of rate backdrop for a prolonged period of time. Do you agree?
Yes, I think Jay Powell agrees with Peter as well. Remember at the last press conference, Chair Powell pointed to the estimates of the natural rate and said that's his committee's, his own view is higher. Well, generally when the chair is saying his own view is higher, it tells you the committee's going up. So I would expect in the summary of economic projections to see a higher natural rate. And importantly, they have to go above their natural rate in order to create some slack that slows inflation. So the base is rising and the overage relative to that base is probably higher, given they started late.
Vincent, what do you expect the unemployment rate to be in those projections? How much of a downside, how much more of a potential recession case do you see starting to leak out in some of this forward look from the Fed today?
Well, the part to worry about is central banks are always incremental. They always don't lay out all the bad news. So I would expect the unemployment rate to go up. I would expect less of an immaculate decline in inflation, as has been the case in the last summary of economic projections. But I still don't think they'll be marking the reality. It'll be worse than what they say. So rather than an unemployment rate at or around the natural rate, as was in the last couple rounds, I would expect to see an unemployment rate around 4.5. In their forecast, I would expect the unemployment rate to be in the 5s next year.
Wow. Vince, you're on the same side as Deutsche Bank then. Vincent Reinhardt there of Dreyfus and Mellon, looking potentially for 5% unemployment. Too early to see that today, do you think, Lisa, in the projections? Because right now there's something close to 4 on unemployment.
Does it really matter? I mean, I think from a strategic point of view, people are going to be looking to see whether they pull a Bank of England and they give a dose of honesty. But does it really matter if they reflect that in their forward projections, if there is a general sense that they bring growth lower and they bring the inflation rate higher, they bring their rates higher, then you're basically going to extrapolate what you want to from that.
We'll catch up with Diane Swank a little bit later from KPMG, and I think Diane said the last few summary of economic projections we've had, the last few set of forecasts we've had, Tom, from this Federal Reserve, she's called them aspirational. Fanciful, I think, was the phrase Scott Minerd used as well.
Maybe we've migrated from fanciful here in the last X number of weeks. John, 4-week moving average on jobless claims. They come out weekly. You take a 4-week moving average. You know the math. 224,000. That is so far from a 5% unemployment rate. I just find the whole conversation.
But Tom, that's the point Deutsche Bank is making. This is what Matt Lazzetti, Peter Hooper are trying to say, that to get inflation lower, to bite into this economy, you need rates much higher. That's their view. That's their position.
Okay, well, we witnessed it. I mean, every airline's packed. I don't know if the airlines are going to make money. We've got certain Uber bulls like Jim Glassman at J.P. Morgan saying, look, here's where the consumer is right now. They've got a tough task if the theories we're hearing on the show are to play out.
And then we've got Mike Wilson of Morgan Stanley, Tom, who's just been right through the whole of 2022. Well, right to be bearish on this equity market.
But the equity market is where it is with the VIX at 26.97, John. And, you know, the classic rule is there's no angst till 30, and you may get a Mike Wilson 30 on VIX. The damage is in the bond market, John. The institutional mass, Lisa knows this better than me, the institutional mass that is losing money daily in the bond market is unmeasurable. I've never seen it in my lifetime.
It's piling up in a big way. At least when FedEx came out last week, I think we both thought the same thing. We both thought of Mike and the call he's making on earnings, that we've had the rate shock and now we're going to see the consequences of it.
And what is the read-through to job cuts? And I say that as we look for a path to get to that greater or a few less slack in the labor market when we talk about a 4.5 to 5% unemployment rate. And you start to wonder, how quickly are these forecasts getting downgrades? And our gap is Boeing, is some of these companies that are coming out, Compass. Are those outliers, or is that going to be much more common?
What would make Mike Wilson constructive on this equity market again?
You can ask him.
The man from Morgan Stanley joins us next. Looking forward to it. Futures up 0.4% on the S&P on this Fed decision day with Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures are positive from New York. Heard on radio, seen on TV. This is Bloomberg Surveillance.
What's been really the engine here has been the strength of the labor market, the strength of the consumer.
The June 17th low is not that far away from here. It's not a heroic call to say that anymore.
We're also not convinced that the data is going to be bad enough that it's going to take us down through new lows for the back end of the year.
The Fed will have to shift, and or we're just going to go into a deeper recession than we may already be in.
The Fed funds rate will overcome the rate of inflation. That's when the Fed has done enough.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on Fed Day. So much to talk about. Richard Clarida will join us, the former vice chairman of the Fed, to lead our Fed coverage today. John, I want to switch from the Fed to the stock market with Mike Wilson coming up. It's a toxic brew out there. There's blood on the streets.
And Mike's got it right all year, Tom. Dead right, dead on. Basically look for the rate shock and now look for the earnings concern. And are we starting to see that with companies like FedEx, like Ford in the last week?
Off the Gulfstream, what I notice is the Bloomberg Total Return Bond Index, John. It is through to new lows, breaching the June lows that we've seen. The 60-40 Bloomberg Index down 17% from the peak. There's nowhere to hide.
Bob Michael at JP Morgan, Tom, says it's going to get worse. He's looking for Fed funds maybe to get close to 5%, for treasuries at 4.5%, and for high-yield spreads to go somewhere close to 750. His message is not to buy yet, to wait, to be patient, to wait for a recession that he thinks is coming soon.
She was expert at unknown. I said, who is that woman in print? Lisa Abramowicz, expert on the spread market. Lisa, the spread market always says so much. What's it say this morning as we go to Mike Wilson?
It's saying there's a little more fear. It's just beginning around the edges, but not getting carried away. And there's a question of what exactly it's pricing in, because it's still far below some of the heights at the other times when we've seen not only rate hiking, but also credit fears. When does this problem, this goes directly to Mike Wilson, when does the issue with rates bleed over to an economic pain story? We've seen that play out in certain equities. Have we seen it fully play out in credit? You know, JP Morgan, at least JP Morgan Asset Management, Bob Michael, that side of JP Morgan.
I like how you clarified
doesn't think that we've seen enough of it.
Not the equity research in the investment bank. Is that what you're implying?
I mean, I don't know that.
Zero Hedge messaged me a moment ago and asked if Bob Michael had spoken to Marco recently. That was the message I received. Read between the lines. I'm not here to cause trouble, okay?
Keeping the gossip running here. I'm going to get the data check going because we need to get to Mike Wilson for Global Wall Street on radio, on television. And John, FX speaks volumes. It is a litmus paper of the system. Yen up through a 144 fractionally. Euro visited new weakness. And sterling, we couldn't support it, John, on our trip there. I tried.
Oh, you tried. I know you did.
113.45.
I'll give you a snapshot of foreign exchange right now. Dollar stronger against everything with the exception of the Swiss franc. That's how defensive things are. Euro dollar negative 0.6% and just about holding on to 99 on euro dollar, 99.08. Yields down 3 basis points. They've been so much higher recently over the last few weeks. In fact, for the 10-year, the last 2 months, 352.79 on a 10-year. Tom futures just a bit firmer, up 1/3% on the S&P.
It is so true that the media, the financial media, loves to look at strategists and say, are you right or wrong? You failed, you're done. The reality is the way strategists are used on Wall Street, and no one has given more guidance this year in the last 12 months than Michael Wilson, CIO and Chief U.S. Equity Strategist at Morgan Stanley, because it's been a consistent and cogent message of beware the future. Mike, we are now where we have a Mike Wilson stock market, and what I note is you mentioned it is picked over. I can't find scale. There's not enough to choose from. Where do I hide?
Yeah, well, thanks, Tom. I appreciate your kind words. I mean, look, I think the market is picked over because this is where we are in the evolution of this bear market. Essentially, when bear markets begin, they always go after the high flyers, things that are kind of ridiculously priced or where the earnings risk is more evident. And that's what happened really, kind of earlier this year, late last year, quite frankly, really began almost a year ago. And, but as you kind of go through, people get in high, it's like, when the water rises, you go to the higher part of the mountain. And so everybody's kind of crammed into the same stuff, just kind of waiting for, some conclusion to this story. Either we avoid a recession and move forward, have a soft landing, or we don't, and we clear the decks, and then we can move forward from there. We're kind of more in that second camp because our view on earnings is just so negative. Whether we have a recession or not, all of our top-down models, which are, pretty good, are telling us that, the spread between our forecast and the actual forecast by the street, bottoms up, has never been wider. It's the only time it's been this wide is, in 08 and then back in 01, and we know what happened there. So the earnings story is what we're focused on. The Fed is important still. Obviously, they're not getting off the gas here on their hawkishness, and nor should they. But that's pretty priced. I wouldn't be surprised if today we get some relief, quite frankly, led by the bond market after the Fed does their thing. Maybe stocks can rally one more time. But the end game for us is all about the earnings and the growth now. And we're just not optimistic there for the next 6 or 12 months, and that'll get priced pretty quickly.
So you've got 3,400 as the base case, 50% probability. Mike, 3,000 the bear case recession scenario, 40% probability. I put out this research, that quote, on Twitter in the last week, and a lot of people wanted to know, where's the other 10%, Mike? What's the 10%?
Yeah, that's the mystery. Now, it's pretty straightforward. The bull case is just not that probable. I think, November, and we talked about this, as you recall, John, the bull case was Goldilocks. And we said, well, the probability of Goldilocks looks pretty unlikely. So our bull case, we can flex that from, 0, or not really 0, but 5 to 20%. We're, sort of 5 to 10% now. But the bull case is no longer Goldilocks. It's kind of this soft landing for the economy. However, that's not a soft landing for earnings. So, our bull case is not much different from our base case. We think maybe you don't make new lows in the bull case, but there's not a lot of upside, over the next 6 months. That's really how we manage money. We look at risk reward, and at 3,900, the risk reward is probably 5 to 1, on the downside, as sort of the middle of our viewpoint, and that's at the S&P level. I want to make this clear because Tom asked the right question, which is, this is the part of the bear market where you should be looking for individual stocks that you want to own coming out of this. Some are priced, appropriately where you want to take that risk. But look what happened this week with FedEx. Clearly that wasn't priced. So you got to be really careful, thinking, oh, well, everybody knows this, it's already priced, and you get hit over the head and the stock's down 20%. So that's, everybody has their own risk tolerance. They have their own work. And, we have our own focus list as well. We're staying defensively oriented. We're not reaching for cyclicality or, kind of crazy growth stocks yet. We think it's premature for that, but we're getting closer. We think we're within a couple of months probably.
So there's an issue with how long this is going to last. And we were speaking yesterday with Chris Ferrone, who talked of a lost decade of profits on the headline level for the S&P, just based on the fact that yields are going to remain higher, inflation is going to be greater. Do you agree, or do you think that we're going to get a rebound on the other side of this 6 months, 12 months down the line?
Yeah, I think we will get a rebound, but our view for a while now has been we've moved out of the monetary policy dominant world to a fiscal dominant policy world. And what that means is that the Fed is no longer, and other central banks, quite frankly, can no longer smooth over the edges the way they have historically, because inflation, while maybe it's going to come down over the next 6 months, which is our core view, it's not going away. It's going to be dormant, and then we'll reaccelerate again in the next upturn. What's going to happen, Lisa, I think, is that you're going to clear the decks enough on expectations on growth that you can then have a reacceleration. And that will be driven by the natural ebbing and flowing of supply and demand, but also more aggressive fiscal policy. I think it's interesting to note in the last month, fiscal policy has been turned down like a spigot again, right? We have this debt forgiveness program here. We have this 200 billion pound stimulus for energy subsidies in the UK, which is equivalent to $1 trillion in a US economic standpoint. So it's kind of interesting. You have kind of, everybody's worried about inflation, but the fiscal policy is working counterproductively to the monetary tightening. But that's the world I think we're living in now. And you have to understand that because it's not all bearish, right? There will be a time when fiscal picks it up again next year, even though monetary can't do its job it has been doing in the past. And the Fed's job, in my view, and the ECB's view, and ECB's job, in my view, their main job going forward is to be funding the government. Whatever the government decides to spend, they will have to fund implicitly, very similar to the 40s analog that we've been using.
Mike, just one further question, and I think it's lost in the conversations I often see with you, that it's not just about an index level call with you and the team. There is some single name stuff in the mix too. Could you help us with just a call right now, something you do like in this equity market, something that has worked that you're sticking with?
Yeah, I mean, I think like the managed care stocks have been terrific, and that's an area that these are growth stocks, and they're not priced as growth stocks, and they never have been because of concerns about perhaps regulatory oversight and things like that. But healthcare in general, I would argue, is an area of the market where you have pent up demand from the pandemic, as opposed to payback in demand, like for technology spending or consumer goods, and for whatever reason, it still trades really cheaply. And that, once again, it goes back to this idea that there may be fear about pricing controls and things like that. But to me, that's a fat pitch, and that's an area we've had a lot of exposure, be it in pharma, managed care, some of the cheaper areas of healthcare, and I think that continues to work. The other area would be, say, integrated energy companies, where they're more defensively oriented, not so dependent on the price deck. They pay a great dividend, and you get some commodity exposure, as a hedge against inflation staying sticky or hot. But the overriding message, John, as you know, this year from us has been defensive, earnings stability, operational efficiency, boring type metrics. But, it's been working nicely, and I think it will continue until we get the trough in this bear market.
It's been working in a tough year. Congrats to you and the team, Mike Wilson, so far for 2022. Just absolutely brilliant. Mike Wilson there of Morgan Stanley. TK, a man who's called it along with his team really, really well through the year so far.
Yeah, what's important here is how they dovetail in. I really can't say enough about the fractious nature of Morgan Stanley research. I love, John, how they're argumentative and visibly argumentative. You saw that with Zentner moving from transitory to a more difficult inflation.
Along with pretty much everyone else, Tom, who had to move from that. Futures up 0.4% on the S&P. It is Fed decision day for our audience worldwide. Heard on radio, seen on TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin declares it a fight to the death with the U.S. and its allies. He is calling up 300,000 reserve troops in a major escalation of the war in Ukraine. Putin also hinted at the use of nuclear weapons. He said that the U.S. and its allies want to destroy Russia. A Ukrainian counteroffensive in the last few weeks has dealt Russian troops their worst defeats since the early months of the conflict. The Federal Reserve is poised to raise interest rates today to the highest level since 2008, and it's likely to forecast that there will be further increases. For the third straight meeting, policymakers are expected to raise rates by 75 basis points. Fed Chair Jerome Powell is expected to stress the Fed's resolve to curb inflation that's near a 40-year high. The Bank of Japan is trying to cap upward pressure on yields before a policy decision later this week. The central bank announced an unscheduled bond buying operation. BOJ Governor Haruhiko Kuroda has emphasized his determination to maintain rock bottom interest rates, even though many other developed nations are increasing them. And Amazon's cargo airline is growing at the slowest pace since the start of the pandemic. Researchers with the DePaul University's Chaddock Institute of Metropolitan Development say the number of flights on the company's air freighters rose just 3.8% between March and September. The e-commerce giant has already closed or delays plans for dozens of warehouses. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I think it's unsustainable to have the Fed hiking rates at a very rapid rate, doing QT with, the economy slowing. At some stage of the game, the Fed will have to shift or we're just going to go into a deeper recession than we may already be in.
Kathy Jones there of Charles Schwab going into that Fed decision a little bit later this afternoon. Futures higher by 1/3 of 1% on the S&P, on the Nasdaq up 1/10 of 1%. Max Kettner of HSBC just publishing, hedge you win, tails I lose. We retain our maximum underweight in equities. If growth continues to hold up, central banks will have to do more to slam the brakes, putting pressure on valuations.
Yeah.
And he goes on to say, but if activity disappoints quickly, falling growth and earnings expectations will also be bad for risk assets. Tom, tails I lose, heads you win.
Can we state in London over that long duration, a wonderful stay there amid the sadness for England, that Max Kettner was our gloomiest guest? I think
He was also a bit of a highlight at the same time, Tom. It was great to catch up with him. Like Mike Wilson, gloomy but right through 2020.
Well, anyone else?
Tom.
No,
I'm
Max,
kidding. I'm just
Max
kidding.
brought the Walker
Ramo, gloomy but right.
Thanks, I appreciate
for the last
it.
12 months.
Thank you. Carry on.
Doing your victory lap. That's it.
I can go around the room.
No,
Maybe not.
It's true, and also her Grand Banks 42 is, that's what it says, John. Gloomy but right.
Is that what it says?
That's my bumper
That's the
sticker.
name of her boat.
Very
right
cool.
now, Michael McKee with us here as we dive forward into the Fed meeting, and again, Richard Clarida is scheduled to be with us, which is wonderful. Mike, I have such a respect for your ability to drill down into this minutia. I just am unable to do it. Which of the forecast, which of the dots, what is the item you will look for first when they release that stuff this afternoon?
Well, I think we're going to be looking at the median dot, which does come out in the SEP as well as on the dot plot, because what people want to know on Wall Street is how fast are they going to get to terminal and what do they think terminal is? And then the third question is, how long is it going to stay there? So all three questions will be sort of answered in one line on the economic projections. Then we'll also look at unemployment, because the Fed is going to forecast under its dot plot what it thinks unemployment will be. And that sort of tells you what they think is acceptable in terms of unemployment if it follows the book and unemployment goes up. So far, they haven't had a whole lot of luck pushing that up.
Yeah, the dot, for those of you on radio, you're advantaged right now because we just showed the dot plot. It looks like the landing effort at JFK in a blizzard. Mike McKee, beyond that, there will be the questions today. It's unfair to say what is a question you will ask. What does he not want to say in the press conference today?
Oh, he doesn't want to say anything about a possible pivot one way or another, whether he uses that word or another. He doesn't want to suggest that the Fed is in any way going to back off. At least for a year, maybe longer. We'll see in the dot plot how long they keep rates up. You look at what Fed funds futures are pricing, and they see the Fed starting to cut rates in May of 2023. And that is exactly the feeling the Fed doesn't want to encourage. They want people to think the Fed's going to get rates up and keep them there until inflation goes down.
Mike, does the Fed have a serious credibility problem?
I don't think so. It's kind of funny. The comment you were leading in with about heads I lose, tails you win is kind of an admission that the Fed is going to do what it's going to do, and they're looking at how that's going to impact asset classes. I think they do need to follow through. If they were to back off at any sign of weakness in the economy, then they would have a credibility problem. But so far, when you look at the inflation expectations, they're relatively anchored. They're actually coming down a little bit. So I think people are have bought into the Fed's program at this point.
One of the biggest unknowns right now is how long it's going to take for this economy to truly feel higher rates. And the reason why this is important is because some people argue that the Fed won't know if they dramatically overshoot until it's too late. How much are people gaming out the length of time, the duration it takes before we start to see the ramifications of a 4% Fed funds rate?
Well, you've got sort of two camps out there. One that thinks the Fed can maybe bring us in for a soft landing, and if it doesn't, it'll be a mild recession, and it'll come probably later next year. And there are others who think they've already gone too far, and we're going to head into the teeth of recession fairly soon. And you see that reflected in those Fed funds futures. But the problem for the Fed is the data they watch to see where they are is backward-looking, and the effects of their policies is forward-looking with the lags. highs. So they've got to try to extrapolate between the two, and it isn't easy. And that is a question on my list for Jay Powell. How are you going to know where you are and whether or not you've gone too far? And they have always said, well, we know how to deal with inflation, so if inflation went up too high, we would know what to do and we could pivot right away. But what if the opposite is true? The economy starts to really fall, and the Fed doesn't know that's happening yet.
Mike McKee, thank you. Mike, thank you very much. And looking forward to the news conference with Mike McKee and his coverage later on the Fed show. The Fed decides. Lisa, we talked about that, didn't we? Is the Fed being emboldened by a lagging indicator?
Well, I mean, and basically, that's the issue at a time when you're starting to see the FedExes of the world come out and say things are moving so quickly, they have to readjust their forecast. FedEx might be dealing with some specific issues that has to do with FedEx and FedEx alone, but we're also seeing it from other companies. At what point does that become relevant for the Fed? Is that data that they're going to track?
Andrew Hollenhorst, the City, just published. He said a hawkish surprise would be Powell suggesting upcoming hikes will remain larger in size or that neutral policy rates have migrated higher. A less likely dovish outcome would be Powell emphasizing that policy rate increases will slow or pause at some point. Tom, once again, the news conference often about emphasis of the Fed chair.
Yeah, and also the market's going to be watching, and we're going to correlate all that in at 2 p.m. here on equities, bonds, currencies, commodities. John, moments ago, Euro Swissy made a dash to new Swiss strength. I would suggest off Russia fears, Putin fears, and that. But we're at a point where dollar's on the cusp of breaking out. We're not there yet, but can you imagine dollar strength into the press conference?
I can, because we're seeing it right now.
I was about to say.
Yeah.
Right now, 110.77, 111 potentially going into this news
Bloomberg
conference.
DXY, same thing.
Yeah, euro dollar just clinging on to 99. Sterling, Lisa, 113. Levels that if we'd mentioned at the start of the year, I would have laughed. And who pointed that out just yesterday in yesterday's conversation?
Yeah, that's right. I think that was Chris Ferrone.
It was Chris Ferrone.
He said,
he called me out in the commercial
laughed.
break. He said, John, I watched back one of our interviews earlier this year. I was like, oh no, here we go. I said 150 on dollar yen and you laughed at me.
And guess what?
We're not at 150.
That was exactly what John said. He said, you totally missed it. We're only at 144.
What a terrible call.
You're just going to keep hammering that. You're going to stick to it, huh?
I think it's a great call. Let's give it to Chris. 143.98 on dollar yen. Michael Pond's going to join us from Barclays in just a moment. Euro dollar just holding on to 99, negative 0.7%. This is Bloomberg. Live from New York City this morning. Good morning to you. Just about positive on the S&P by 0.5% on the S&P 500. Futures up on the Nasdaq by 1/3 of 1%. Also pushing higher, yields pushing lower by 4 basis points on a 10-year, 352.60. Euro dollar just about holding on to 99, 99.06. That currency pair negative 0.6%. Some real dollar strength out there in the mix. Shout out to Paul C on Twitter. We've got to rename the program, Tom. Bloomberg, the Brit, the Bear and the Bow Tie. Great way to start the day. Thank you. Thank you very much for that. I think that works. We should rename the podcast The Brit, the Bear and the Bow Tie.
Yeah, we could do that. I think the podcast that works as well. And
that works beautifully.
Digital product. And if you look over the years, the digital product's becoming more and more important, including podcasts. We're working on that every day with Scott Havens, and we'll move forward on that now that we have all returned. Right now, we return to what started the program years ago, which is speak to people that actually spend 24/7 on something narrow and excellent. David Rosenberg, Parsing Inflation, maybe Stephen Englander in his brilliant work on cross rates and FX. One of those some years ago was Michael Pond. His fancy title now is Head of Global Inflation-Linked Research at Barclays. Far more accurately, he is truly expert, with the exception maybe of Ian Lingen at BMO, on full faith and credit, and he joins us today. Michael Pond, if I look at the real yield, and I look at two partial differentials of the nominal yield and some measurement of inflation, which matters right now?
It's the real yield that matters, and it's moved up a lot over the summer. The market was not really buying into the Fed's resolve to hike rates enough to slow the economy and getting inflation down. Since Jackson Hole, though, real yields have soared, particularly at the front end, where they were almost at zero earlier this month. Now they're above 1% when we look at short end forward. So the market's moved a lot and really accepted the hawkish tone of the Fed.
So if I look not at the 10-year real yield, but Michael Pond, let's go shorter to maybe the 2-year, if you agree with me on that, from a negative 300 basis points inversion to a positive 164 basis points. That's a hugely linear jump condition. How do other asset classes react to the Michael Pond world?
Well, risk assets do not love higher yields that are not supported by strong growth. Really, where real yields are rising here is because the Fed has become much more hawkish, trying to slow the economy. And that's in part why risk assets have been on the back foot since Jackson Hole. So the Fed's trying to get the economy in a position where inflation comes down, and then it can take its foot off the brake a little bit and allow growth to go back up. But we think we're years from that. The Fed's resolve is strong here. That was clear at the Jackson Hole speech by Chair Powell, ripping up the script then and channeling his inner Volcker. Risk assets have responded, but now they're at the point where perhaps they've overreacted. You know, obviously we'll get a message from the Fed that's on the hawkish side, but markets are already prepared for a very hawkish Fed. So it's a delicate balance today.
Before we veer too far into that, they might be prepared for a hawkish Fed. There's a question of how quickly that leads to economic deterioration, and we can get there. But I want to sit on this idea right now of what it means to have a Volckerized Federal Reserve, particularly with real rates at the highest levels going back to 2011. Do you foresee ever again in the next few decades this Federal Reserve going back to zero interest rates?
It's very possible. We thought that the market was pricing in too high of a probability of strong Fed cuts in next year in late summer. Those have basically been taken out as appropriate. But we certainly could, if you look at the housing market and say the housing market becomes a sign of the broader economic outlook, then we could be in trouble here, and the Fed would have to respond, putting its dove hat back on. We think we're not likely to enter that regime, but it's certainly possible that we enter a recession. The Fed has to backtrack and send rates right back to zero.
Well, okay, so this is sort of the big tension right now in bond markets, particularly on the long end, with the 10-year yields at the highest levels that they've been going back years and years, and yet some people, including Michael Collins from PGIM Fixed Income earlier, saying it's unclear whether it's really time to pounce because there could be more. Is this the last time that we'll see real yields of this level because this Fed is poised to make some sort of turn in the not-so-distant future?
I think it 100% depends on the path of core inflation readings and the labor market. That's why the Fed is reacting so hawkishly here. They've done quite a bit. Some parts of the economy has begun to slow, such as the housing market. But the latest print on core CPI was 0.6, and labor markets clearly remain quite tight, quite robust at a 3.7% unemployment rate. The Fed really needs to see a slowdown in the monthly pace of inflation readings, particularly on core, and a weakening of the labor market. Again, the chair talked about inducing pain in the economy. Again, channeling his inner Volcker in order to get inflation down. So the Fed has to do a lot more to get the economy where it wants to.
Michael, you embrace a dual mandate, and I get that. And we could talk all day about jobless claims, this, that, and the other thing, or trimming Dallas. Maybe the chairman will bring that up today. He's got another mandate, which is the credibility of the Fed buttressed up against political realities. If we get a Barclays recession, if we get a Barclays sort of recession, does that become a third mandate for this chairman?
Well, the Fed is absolutely trying to make sure it retains credibility, particularly when it comes to inflation fighting. So one of the reasons why it's being so hawkish here is to make sure that inflation expectations don't get out of control, because that's when the Fed fears an inflationary spiral, where inflation is high, people expect it to be high, and it just feeds on itself. So one of the things the Fed is trying to do here is make sure that high inflation itself doesn't lead to higher inflation expectations. So it's trying to maintain its credibility. And if we look at break-evens, if we look at surveys such as that from the New York Fed or the University of Michigan, the Fed's doing a good job on that front, and it's able to ignore any political issues with a slowdown.
John, I'm sorry, politics matters here. It's going to matter tomorrow for Bank of England. It's going to matter today for Chairman Powell.
Oh, Tom, I don't disagree. And I think, Michael, this is going to be the difficult part. How do they convince people that higher unemployment is a price worth paying for lower inflation? Easy to say that now, but when people actually start to see materially higher unemployment, how difficult do you think this is going to get?
Well, that's why the SEP, the Survey of Economic Projections, or the DOTS, if you will be so important today when we get the statement. When we look at the statement, one of the things we'll be looking at is the unemployment rate path. So, you know, the SEP is supposed to be the economic outlook under a path of perfect monetary policy. And if the unemployment rate remains elevated in their forecast, that's a signal to the market that they're willing to tolerate decently higher unemployment rates in order to get inflation down. That's a message that the Fed has been sending, but we'll really be looking at the SEP to confirm that.
Michael, just real quick here, I'm wondering what your projection is for how quickly inflation will come down, that headline CPI, at the end of this year, at the end of next.
We're fairly optimistic that it will start to slow, particularly with the October reading, in part because of technical reasons, at least in CPI. But even beyond that, again, we've seen signs in commodities and shipping rates, in ag-related futures, corn, wheat, et cetera, that many price pressures have peaked. Wages, though, are keeping inflation high, and that's the key to inflation really rolling over.
Michael, just quickly, what are you talking about in terms of levels? Are we going to end the year at 6%, at 4%? When do we get back?
We think we'll certainly come down from that when it comes to headline inflation, in part because of the strong decline in gasoline prices since March. But core can remain sticky. So we think we'll slow in inflation readings, but certainly well above where the Fed would like them.
Michael Pond of Barclays, thank you. Everyone at Barclays went very quiet when this interview started. I can tell you in the commercial break there was this beautiful buzz, this hum coming off the trading floor over at Barclays. Tom, wasn't that fantastic?
Yeah, they put
and thanks to Michael too.
Senior management put a memo today. Pond is on with surveillance, so
I know, but they should just
pipe in some
that
music.
Buzz,
the
TK,
buzz
was just
great.
beautiful.
Just like old
I've
times.
missed that.
Yeah, well, and frankly, for Q4 and into next year, that's a big debate. John, The Guardian in London, the acclaimed Ian Fraser, one of the great authors and thinkers of economics in your United Kingdom. I love what he resurrects from Ronald Reagan, trickle-down economics. John, is that what we're observing?
Yeah, you should probably have a look at the Martin Wolf piece in the Financial Times as well, because it was pretty scathing, TK, and what's about to come from this Conservative government.
Well, you know, this is out there and in real time. And, you know, frankly, for our American listeners and viewers, what goes on tomorrow has a profound effect on what goes on in America.
We get a Bank of England rate decision and a mini budget. I've got no idea
John, I meant does Sun start?
Oh, that's
the
what,
next
that's
game.
what you meant.
That's what I meant.
That's important too.
That's important.
I've got no idea if Martin wrote this headline in the FT, but Lisa, the economic consequences of Liz Truss was the headline of that piece in the FT out yesterday.
Well, Danny Blanchflower over at Dartmouth, he put this out on Twitter.
It's pretty predictable, isn't it, Danny?
Okay, yes, but he said, you know, he's done many interviews. He's discussed these disastrous economic policies of Liz Truss, as he said, and he said that they're in total disarray, but it seems inadequate as pronouncements get worse daily. I have never in my 50 years of doing economics seen anything as bad as this.
I want to see what the complete package looks like. The two that we've heard of, ending the cap on banker bonuses, that's going to get the wrong kind of headlines. Then the one that we heard of in the last 24 hours was on reducing stamp duty, which for anyone not familiar is just the transaction tax that you pay when you buy a purchase or a house in the UK, Tom. And that's at different levels relative to how much that property costs. Let's see what the complete package actually looks like.
Yeah, well, you know, when I was looking at Knightsbridge yesterday, that's why I came back a day late. You know, they said maybe the transaction tax would be gone.
You trying to buy TK?
Well, we're looking.
I'm not sure. You know that you can go on stamp duty. Just Google it and have a look at how much you'd have to pay on a big property in Knightsbridge.
Like, you're kidding me.
Like real money.
Yeah.
I mean, you need the real money to begin with to buy the house.
But I mean, is real money at a 105 sterling or here at a very rich 113 sterling?
Are you waiting for it to decline a little bit more?
Yes, I am.
Okay. Euro dollar 99.12. We've got a stronger dollar in the mix. Equity markets firmer. Yields are lower. All of this going into the Fed a little bit later. Looking forward to a Fed Decide surveillance special a little bit later. Do not miss this with the former Vice Chair, Richard Clarida, in the studio with the three of us, breaking down the decision and going over the news conference too. Do you want any more than that, Bramo? Isn't that just fantastic?
I'm so
Fed Day?
excited.
And Chairman Powell's going to... He's not calling it.
He's only,
Right.
Clarida's only here. Clarida, John,
He's not
Clarida's
calling
only
it.
here to see Bramo. He doesn't care about us.
He doesn't care about us. He's here to see Lisa, of course. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin is threatening to escalate the war in Ukraine even further. Putin is calling up 300,000 reserve troops and vowed to use all means necessary to defend Russian territory. He also hinted at the use of nuclear weapons. Meanwhile, the Kremlin is moving swiftly to annex parts of Ukraine occupied by Russian forces. The Fed's ready today to hike again and to send a hawkish message. For the third meeting in a row, policymakers are expected to raise interest rates by 75 basis points, and that would bring rates to the highest level since 2008. Chair Jerome Powell is likely to hammer home that he believes further rate hikes are needed to tame inflation. European Central Bank President Christine Lagarde says borrowing costs will rise more in the months ahead. Speaking in Frankfurt, Lagarde said the ECB has taken major steps to tackle inflation, and she expects to raise interest rates further over the next several meetings. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
There is some thought that we're getting to peak hawkishness, but that's not going to move the market now. It's the earnings that are going to move the market and a realistic reset of where we're going in this.
Alicia Levine there on the equity markets with BNY Mellon Wealth. She's just given us so much insight, particularly with her math foundations. Before we move to events with the United Nations General Assembly, Lisa, I think we've got to look at what's moving in the market. And just one idea off of what John was mentioning on the Bank of England tomorrow, if you take the sterling, Lisa, and you extrapolate it out, the weakening has been so rapid that we see a 1.1099 extrapolation in a cup of good British coffee, September 29th. I find that extraordinary, Lisa.
The fact that people are talking about the potential for parity at a time where there's a 1-2 whammy punch of an economic backdrop forcing the Bank of England to raise rates, and then a fiscal plan that has endless spending and tax cuts, that's leaving a lot of people wondering where the foreign investment is going to come from.
We'll continue to monitor this, and of course we go to our Federal Reserve coverage this afternoon with Richard Clarida. We're just honored the Vice Chairman would choose to give us extended comments. I'm sure he'll be delicate there and a delicate moment for Chairman Powell. Right now, it is a delicate moment for anyone efforting climate, and I will not mince words. Michael Bloomberg, who signs my paycheck, has been a world leader in saying, forget about the big picture and look at the smaller tactical realities. He provided leadership at Paris a number of years ago on this with the mayor of Paris, Ms. Hidalgo, and does again today with the Earthshot Prize. Francine Lacroix is covering this story and will be part of selected panels there. Francine, this is the effort of the Prince of Wales. He is distracted with the sadness of his family. What did Prince William bring to the Earthshot Prize Innovation Summit?
Well, Tom, this is about, I think, rallying the troops. This is about finding small innovations, as you say, that could actually make a real difference in real-world economies. So this is very much at a city level. This is incubators. This is about getting funding to the right place. But remember, we're here in New York, and the overarching idea is that, yes, we see more and more climate disasters. We see, of course, our woods burning. We see the forest burning. We see no water in the Rhine, which is a whole host of problems for the economy. But if you're a world leader and you focus, of course, on world poverty, inflation, the war in Ukraine, this may not be a priority anymore for you.
How has this prize and the work of Prince William changed because of the war, because of the surge in energy? Not the threat to ESG, but the idea of climate debate on a back foot due to the price of commodities and coal. How has it changed this summit?
Well, it's changed it enormously, and I think the biggest story to come out of the UN in general was President Biden today meaning to attend a meeting to actually really lay out some of the groundwork ahead of COP27 in Egypt, saying actually he had no longer time to go to that meeting. Now, of course, he sent envoys, but it's not exactly the same thing as having the top boss and saying this is still a priority. Again, if you look at energy concerns, if you look at the cost of living crisis, there is a real concern, which actually the United Nations Director General addressed right at the start of UNGA yesterday, was like climate still needs to be left front and center. The other question is that, of course, King Charles III, I know you were in London for 10 days covering, of course, the funeral of his dear mother, Queen Elizabeth, was a real spearhead in this. And if you look at the UK with all the concerns about, sustainability, they even have an energy minister who is not the biggest champion, let's put it that way, of climate change efforts. It's possible that the king has to step down for anything vocal and to really try and push this climate change agenda.
Francine, how has the shortage in commodities, or maybe not the shortage, but the higher demand on certain commodities, changed the conversation in terms of what commodities will be necessary for the innovations to cleaner energy?
So this is one of the conversations that I used to have, for example, with the Glencore chief executive. For the last 4 years, remember, they still have coal mines, but a lot of these big miners, and we saw some of the efforts, for example, from Fortescue, keep on saying, look, it's all well and good to transform some of these transition economies into something greener, but you need cobalt. You need some of the components that, of course, are needed not only in electrolysis, but some of the technology needed. And he used to say, the fact of the matter is that the government has not prepared for this. He wasn't talking about one specific government. He said the US is not prepared for this, the UK one, even the Eurozone is not prepared. With time, and if there is still commitment from not only countries but private and public partnerships, then you could see a lot of the mining companies, again, really ramping up some of the cobalt and some of the minerals really needed to use in these components. But, again, it's about commitment and it's about the money to be able to make sure that these places are secure.
Francine, thank you so much. Greatly appreciated, from the Plaza Hotel and the Earthshot Prize Innovation Summit as well. In the time that we've got left here, Lisa, I think we have to frame back to just an absolutely tumultuous 2022. It seems like we've lived 2 or 3 years just going through the years today. And my great observation, Lisa, is we're at a point where we're not even to neutral yet, based on all the experts we talk to.
It's shocking. And just to give you a sense of that, more than a dozen central bank meetings and rate decisions will be had in the next 24 hours as we look out at all of these nations dealing with something very new relative to the past decade or two, which is inflation. And one way to kind of look at this reset, this regime change that we've been talking about, Tom, is to take a look at the total amount of negative yielding debt outstanding. This is now becoming obsolete, save for Japan. We now have $1.9 trillion of negative yielding debt outstanding, according to Bloomberg indexes. Just to give you some perspective, that was $18.4 trillion of negative yielding debt in December of 2020.
These are flows of money, and the flows destabilize. We had this. Let's try to get this up right now. Just from the beginning of the year, it's not year to date, but it's close enough to the peaks that we've had, Lisa. The Pacific Rim ex-Japan, which is a fiction, we all understand that, a 9% depreciation. The JP Morgan emerging FX indices, which is more complex, an 8% depreciation. Those are big figure numbers in foreign exchange and for the United Nations and, frankly, for Chairman Powell.
Yeah, and the extreme version that John was showing earlier of 25% depreciation of the Japanese yen in the more violent example here.
Right.
But yeah, especially the emerging nations. How do you deal with also a double whammy of both higher commodity commodity prices and importing inflation, the fact that those commodities are paid for in dollars that are getting stronger, becomes a very difficult equation, especially as we head into winter.
2-year yield, 3.95%. That's what I'll watch here at 2 p.m. and on to 2:30 in the press conference. Lisa, in fixed income, what will you watch?
I mean, I'll watch the real yield. I'll see how much people are expecting the Fed to stay out in front of inflation and not provide the same kind of accommodation that they have in the past. And also just in terms of risk appetite, how much have we priced in, right? I mean, basically, if you get real yields continuing to climb, that continues to make triple leveraged all cash, look good to some people who might like it.
The 2-year 30 spread. Wow.
Yeah.
Negative 41 basis points. I did not realize that, Lisa, how that's plunged.
Isn't that the greatest inversion going back decades?
I'll have to look at that. I failed. I didn't do my homework.
Welcome back, Tom.
Maybe I'll get it right by 2 p.m. this afternoon. Again, we are honored that Dr. Clarida will join us in the 2 p.m. hour. Stay with us. This is Bloomberg.